Welcome to the European Market Open. A minute to go until the start of cash equity trading. I'm Tom McKenzie in London, and here are your top stories. Optimism fades. Credit Suisse bonds fall deeper into distress. The troubled lender and UBS are said to oppose a forced combination. Regulators to the rescue. Global stocks rally with the Nasdaq set for its best week of the year after the Fed provides backstop liquidity to US banks and First Republic gets a $30 billion lifeline. Plus, the ECB sticks with a 50 basis point hike as President Christine Lagarde vows to support the region's lenders amidst the recent turmoil. Let's take a look at these futures then. Headlining, of course, what's been happening with the Nasdaq. A remarkable week for that tech-heavy index, looking to gains of plus 5% as things stand. The futures here pointing to upside of 0.6% as we digest again more market moves and more regulatory moves out of the US, but specifically the teaming up of JP Morgan's Jamie Dimon and Janet Yellen, the Treasury Secretary, of course, to provide that deposit support for First Republic. To what extent will that ring fence the contagion risks? And we will be discussing that, of course, and working through the detail in the 30 minutes ahead. The FTSE 100 currently gaining 0.5%, adding 36 points. The Spanish IBEX also up by 0.5%. Of course, Madame Lagarde coming in with 50 basis points. That was a hike from the ECB, but dropping the messaging around forward guidance for rate hikes, and again pointing to, yes, high inflation, but also saying that they have the tools at their disposal to address any risks around the banking sector. The gains strengthening now. You can see that reflected in the CAC on a full 1% gain in the French index. 67 points is the upside. The UK now, the FTSE 100 gaining close to 0.8%. Let's switch it over and see how things are playing out cross asset. Just worth reminding you what happened in the Asian session as well, because you did see some decent upside for Asian banks on the back of the action that we saw out of the US, but also the tech sector rallying on the back of some artificial intelligence enthusiasm linked to Baidu and its chatbot. The HS Tech Index then, tech heavy, of course, listed and parked in Hong Kong, gaining 4.5%. The Nasdaq futures pointing to further upside then. Again, you're looking at gains of more than 5% as things stand for the Nasdaq this week on expectations that rates will come in slightly lower and increased liquidity, of course, coming through from the Federal Reserve. Gains of 0.1% for the Nasdaq futures. Euro dollar 106, the single currency supported, gains of 0.5%, tying in to the moves around 50 basis points from the ECB, but also softer dollar as well. 2-year, you've seen, of course, these moves lower in terms of yields. You're still about 80 basis points below levels that we got pre that hot data around inflation. You're looking at February the 2nd, around that kind of time. That's where yields are back to 4.13 at the front end, and that's a move of just 1 basis point today. Now, it has, of course, been a crazy week for lenders around the world. Here in Europe, concerns, of course, about the future of Credit Suisse continue to dominate, and in the US, the banking turmoil following the collapse of SVB is rolling on. Let's bring in Bloomberg's Oliver Crook in Zurich, Tom Metcalf, of course, from our finance team, and let's start with Credit Suisse. Oliver, where do we stand this morning?
Right, Tom. Well, it's a quieter day in the markets for Credit Suisse. It's a quieter day in general, apart from these trucks that have just arrived. One of which is, by the way, the florist who works here, who told me he pulled all of his money out of Credit Suisse back in October. So listen, this is an ongoing saga here at Credit Suisse. We seem to have, the S&P has earned stability in the market. The question is it enduring stability? Is it the kind of stability that will allow Credit Suisse to have its turnaround plan executed without any other outside influence? And this is still very much an open question. Tangibly, what we're looking for going forward are clients holding on. We've had some reporting out about some clients departing. We don't know how big that is, so it's hard to speculate on that. Our counterparties sticking around, and also our staff sticking around. All of this stuff will sort of add up to what this story looks like over the next couple of days for Credit Suisse. They'll calmer this morning, up I think about 1% in the market this morning on the stock.
Yeah, we're going to watch, of course, the stock and how the bonds are trading, the CDS as well, of course, for Credit Suisse. The redhead for me, though, Ollie, is that your florist over there in Zurich called this back in October. But seriously, what is the way forward for Credit Suisse?
So this is the open question. Obviously, this episode does nothing good for what is already an extremely painful turnaround. So this will bear on the morale of the bank, attracting and retaining talent, and crucially, it bears on the cost of doing business and the reputational cost. So going forward, there's a lot of analysts that are skeptical that this, despite the sort of stopping of the hemorrhaging on the shares, that this S&P liquidity injection is going to be sufficient for this bank to go on by itself. Again, this is all sort of speculation at the moment. We have Credit Suisse behind us. Just over there, looming large, is UBS. And this is where JP Morgan says is the most likely outcome, a takeover. But again, there are a litany of issues that come with that. There's a lot of client overlap between UBS and Credit Suisse. And UBS's intention is to expand in the United States. An acquisition of Credit Suisse does not do a lot for them in that realm. The Swiss would like to keep it in the family if it needs to come to that. But the question is really, also, and from our reporting, does UBS have the same risk appetite? Do they want all the clients that Credit Suisse have in the wealth management? That, there's some doubt in that in our reporting. So going forward, we'll have to see how this shakes out. But again, it's going to be the market that's going to call the shots on this.
Yeah, and as you say, both sides from our reporting, UBS and Credit Suisse, pushing back on the idea that they could combine as a result of this. Bloomberg's Oliver Crook, of course, on the ground in Zurich, covering all things Credit Suisse. Thank you. Let's bring in the broader picture, though. Over in the US, Wall Street's biggest lenders have thrown First Republic a lifeline. It's quite significant and unusual, of course, $30 billion in terms of deposit support. Let's bring in Tom Metcalf, of course. Tom, what do we know about the support that's come through from the larger lenders? Are they just shuffling the deposits around at this point?
Yeah, it's a really fascinating setup, and it actually calls back to something in 1907 when basically JP Morgan himself effectively organised a rescue of the banking system. So what you're having is about 11 of the big US banks putting in a total of $30 billion, and just moving their deposits into First Republic with the idea that, hey, that boosts that liquidity, they're part of the solution, and hopefully, First Republic can recover. Now, yesterday, its shares really soared on this, but in pre-market trading, we're seeing those shares down, so it's kind of interesting to see just how much this has resolved.
And we have a little bit more detail, a little bit more clarity in terms of the tapping of the Fed's reserves. Yeah. Two different facilities, the discount window, more in terms of the liquidity tap from the discount window than we saw during the Great Financial Crisis, a total of about 165 billion. It seems like a huge number in just the space of a week. Did it surprise the markets? Is it going to surprise the markets?
So this is how the system's meant to work, I suppose. So, it's showing that, the structures in place are helping kind of bring in liquidity when it's needed. But yeah, just in terms of like a historic number, that is about, I think, 40 or 50 billion more than at the height of the 2008 crisis. So it does just go to show, look, this is a moment for finance. I think the system is working and kind of, the liquidity is being provided where it's needed. But yeah, that was I think the number, sort of the quantum was maybe expected, but perhaps not quite as big a difference to 2008.
Okay, this is a moment for finance. It certainly is. Tom Metcalf, of course, from our finance team, we've been run ragged on this story and, of course, doing an excellent job keeping us up to speed on the implications across this sector. Let's bring in Norman Villeman now, UBP CIO for Wealth Management. Norman, good morning. Let's get your views, your take then on the support that's come through from the larger banks for First Republic in the shape of $30 billion of deposits. Does it do enough to prevent contagion and ring-fence the risks?
What it does is to buy time, and I think that's what they're doing. That's what the Swiss National Bank are doing to try and get these banks to more durably strengthen their balance sheet and their business model going forward. I think what you've seen out of all the central banks now is they're committed to providing this liquidity to keep buying time, and I think that is the key word right now.
So what do you do with US banks in this environment, Norman? Are you staying on the sidelines at this point?
We are staying on the sidelines because even if you believe that the Fed is going to be successful, the regulator is going to be successful at stabilizing the system, when we come out of this, one of the things that we think results from this, especially for the small and mid-sized banks, is certainly a much more robust regulatory environment, something that looks a little bit more like the systemically oriented banks in the system. It probably means that you're going to have much more limits on their ability to make money. So you're not going to see the same flexibility that they've had in the past to generate returns. So the return profile probably declines from here and makes it a less attractive profile for investors.
The return profile looks very different, doesn't it? And indeed, if they have to raise the rates on those deposits to continue to hold their clients and their customers, that would presumably erode profits further. Meanwhile, Norman, your take on the tapping the Fed's window, the liquidity impulse coming through from the Federal Reserve to support this banking system, and what we make of the fact that their efforts around QT have basically been reversed about 50%. The support then coming through and the impulse for equities then in the short to medium term from that additional liquidity.
Well, the liquidity, and you rightly point out, the impulse to equity is enormous. So we have the Fed obviously growing its balance sheet really for the first time in a while here. What surprised me as well, with Credit Suisse drawing on a 50 billion Swiss franc loan from the SNB will be growing its balance sheet. And we are seeing central banks around the world, in Japan as well as the People's Bank of China, growing their balance sheet. The last time we saw an aggregate this happen, we got a rally going in through year end. And so that will end up being a near-term tailwind for risk assets here.
I mean, it's such a sharp turnaround of events just in the space of a week that we're talking about central banks expanding their balance sheets now. It just wasn't a prospect 5 to 7 days ago. Norman Willemans, UPP CIO for Wealth Management, staying with us. We'll get more takes from Norman just in the next couple of minutes on Credit Suisse, of course, but also on the ECB and the actions of these central banks. Stay with Bloomberg. We're going to take a deep dive into the hot water that Credit Suisse finds itself in, and of course the ripple effects from Silicon Valley Bank. Tune in to our special program, Banking Breakdown, today, 8:30 a.m. London time. Today's Big Take, meanwhile, taking a global look at what's been, of course, a week of turmoil for the banks and what may be next for this embattled sector. Terminal users can head to NI Big Take Go for all of that. And coming up, the ECB delivers a half-point hike amid the market turmoil. But what's next for the central bank? This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Studios in New York and San Francisco. Our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg. Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
In Europe, we have strong supervision, we have strong capital, and we have solid liquidity positions. And as the Vice President said, exposures are not concentrated. And based on the work that has been conducted by the SSM, we don't have similar occurrence as the one that occurred in California, for instance.
Okay, that, of course, was ECB President Christine Lagarde talking about the strength of the European banking system. And despite the recent banking turmoil on both sides of the Atlantic, the ECB went ahead with a planned half-point rate hike, but the European Central Bank offered few clues on its next move. Let's bring in Bloomberg's Maria Tadeo then, who has been monitoring this. Maria, ECB, of course, delivering 50 basis points. What is next? What did we hear from President Madame Lagarde?
Well, Tom, they stuck to the script. It was 50 basis points. Remember, a lot of the time yesterday morning, we were debating whether or not it would be the data or the volatility that would flip this decision, and the European Central Bank stuck with that 50 basis points guided that they had calibrated for the meeting. What changes, though, and this is significant now, is the forward guidance. In many ways, you can kiss it goodbye. It's gone. And Madame Lagarde, in very candid language, essentially said that, given the context that the central bank is operating at this point, it is very difficult to predict what's going to happen in 2 months down the line. This will now come down to meeting by meeting, and it's full-on data dependency. One point that I do want to mention, though, when it comes to the data, and this is new, yesterday she laid out what seems to be a new criteria that focuses on 3 points. The first point is the incoming data on both the economy but also financial data. The second is dynamics when it comes to core inflation. And the third is the strength of the transmission policy. A lot of that will now guide decisions for the central bank. But again, as I said, in many ways, it's au revoir to the forward guidance. That is gone now.
Au revoir, adieu to the forward guidance. Kissing that one goodbye from Madame Lagarde. Meanwhile, she's trying to strike this balance, isn't she, Maria, around focusing, of course, on the questions around inflation and getting back to that target, whilst not being derailed by the financial stability risks. There is a point, there are times when the two come into collision. Can they handle both?
And that's an excellent point. And Tom, it really dominated that press conference. And what she said, and to me, this is one of the takeaways that I got from this, is that she doesn't see it as a contradiction. There's no trade-off. You can handle both price stability and financial stability. That is the job of the central bank. By the way, when it comes to inflation, she repeated a number of times the determination, the stamina to bring it back to 2% has not changed. And when it comes to financial stability, she said, well, remember, I was around in the 2008 financial crisis. The picture that I see for Europe right now is different and does not see a problem when it comes to liquidity. I also want to say, Tom, I got a note from Deutsche Bank this morning that is actually pretty positive on that question that you asked. Can they handle both? Deutsche Bank says the tone was right because the market was able to digest 50 basis points amid turmoil.
Very interesting indeed. Larry Summers also applauding the response from Christine Lagarde of the ECB. Maria Tadeo, thank you very much indeed around that important decision from the European Central Bank and, of course, the lack of guidance, forward guidance going forward. Let's bring back Norman Villeman, UBP CIO for Wealth Management, still with us. Norman, you look at the share price action today. Credit Suisse down again about 0.3%. That's nothing compared to the drops that we've seen in recent days. Of course, it did rally yesterday, but not offsetting the downward pressure more broadly. The banking sector, though, across Europe, though, rallying more than 2%. So clear divergence there. What is your take? Look, you're well versed in the Swiss banking system. What is your take? Can Credit Suisse weather this storm?
Yeah, look, I think the lens that I'm looking at this through is drawing upon the situation of the Royal Bank of Scotland in the UK almost a decade and a half ago. They'll weather it, but it's going to take a long time to work it through, and it may take more than this backstop that came in yesterday, just as was the case with the Royal Bank of Scotland many years ago. And so that's what we should expect out of the Credit Suisse situation. It'll take a long time to resolve, but the Swiss Central Bank will keep them around to maintain system stability.
Okay, what does that more look like in the context of, and Bloomberg's been doing its own reporting on this, at least anecdotally, examples of outflows ticking up because of the headline risk around this bank. What does that more look like in terms of the support for Credit Suisse? And are you putting to one side, are you pushing back on the idea that they're going to have to fundamentally restructure and that the whole UBS Credit Suisse story is not running here?
No, look, without a doubt, they need to fundamentally restructure, and that's what we saw with RBS coming out of their crisis as well. But the question is how quickly does that happen? And what the Swiss National Bank, it seems, is trying to avoid is that happening in a very rapid fashion that causes instability for the system as a whole. And so we think that's what the liquidity support was about for Credit Suisse, to ensure they have liquidity to meet depositor needs, to meet their ongoing needs going forward, and effectively to buy them time to dispose of assets, to raise capital if needed, and to execute their restructuring plan.
Norman, double-digit losses for the European banking sector just in the space of a week. Just in the space of a week, of course, after many investors have been positioning into financials on the back of these higher rates. Currently, the sector gaining 2.3% just in 19 minutes into the session today. Do you buy the dip in European bank stocks, Norman?
We don't buy the dip in European bank stocks at this point, but what we are looking for are outside the sectors where you're seeing the anxiety really build on the part of investors, where we can see good value, good quality balance sheets that are being disproportionately hit by this flight to safety. And I think that's where the opportunities investors should start with, until we have a bit more clarity on the overall financial system going ahead.
Norman, what are you saying to clients at this point more broadly? Are you asking them, are you telling them, advising them to put more of their portfolios into cash, position into cash, wait on the sidelines, or are you taking opportunities as they arise? How much hedging do you want to be doing in this environment?
I mean, to be honest, we entered 2023 with a rather cautious stance. One of the areas that we quite liked going into this year in anticipation of volatility, let's be honest, we didn't know it was going to come in this way, but we did think volatility was going to pick up. But this really plays to the alternative universe, the hedge fund universe, which we think actually capitalizes on these spikes in volatilities, these big macro shifts that are taking place in the global economy.
Okay, so the alternatives maybe is somewhere you want to be. Hedge funds being called out there by Norman Villeman, UBP CIO for Wealth Management, remaining cautious given the volatility and turmoil we're seeing, particularly emanating from the banking space. Norman, thank you very much, of course, for joining us and the analysis this Friday morning. Coming up, we're going to take a deep dive, of course, into the hot water that Credit Suisse has found itself in. The ripple effects as well from Silicon Valley Bank. Tune in to our special program, Banking Breakdown. That's today, 8:30 a.m. London time, just 9 minutes away. This is Bloomberg.
Was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
News breaks. No one covers the world like Bloomberg.
This is the biggest issue right now facing Ukraine. Last year was all about weapons. This year to ammunition, as they are facing a potential this spring fresh offensive from Russia.
They are very hopeful that there is going to be a recovery. It's not as bullish as some people were hoping. Obviously, markets today very disappointed with the numbers.
This next president is really going to have to come in quite aggressively to deal with a lot of these economic issues that people are dealing with on a daily basis.
Bloomberg, your global business authority. This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
Welcome back to the Open. We are 24 minutes into the European trading day. Gains across the benchmark of a little over 1%. Let's get to the Bloomberg First Word News now with Madison Mills in Dubai. Madison.
Thanks, Tom. Chinese leader Xi Jinping will travel to Russia next week. It's his first trip to Russia since it invaded Ukraine. During the trip, Xi's expected to discuss China's recently released 12-point blueprint for ending that war in Ukraine. That document dismissed by most Western governments. Xi and Ukrainian leader Vladimir Zelensky also plan to speak by video link soon. Meanwhile, China's Communist Party has unveiled details of a restructuring plan, placing the finance and technology sectors at the heart of its control. A new central financial committee will be absorbed in an existing state council body, and a central technology committee will be established to strengthen the party's oversight of that industry's development. And in the United States, TikTok reportedly in talks with potential buyers. That comes as the U.S. presses its Chinese parent company to divest. New York Post says TikTok is exploring possible deals it had considered when former President Donald Trump threatened to ban the app back in 2020. Meanwhile, in the UK, the popular video sharing app has been banned from government phones due to those same security risks. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
All right, Madison Mills in Dubai. Thank you very much indeed. Let's check in pre-market with some of these regional lenders then after this pretty remarkable turn of events. Some of the larger lenders, of course, coming to the fore and aiding with deposit injections for First Republic. That stock pre-market down 8%, despite this lifeline being provided by JP Morgan. Of course, Jamie Dimon corralling the larger banks around this support, $30 billion in terms of deposits. Pre-market, First Republic down around 8%, PacWest down 3%, and Western Alliance Bancorp currently gaining 0.9%. More broadly, low, this is, when you look across these markets, a moment where it seems investors have taken pause, taken a deep breath, and are just collecting their thoughts, given everything that's happened just in the last week. Let's check in on Credit Suisse, though, because their shares are up just 0.6%. Of course, investors continue to digest the support from the Swiss National Bank. More broadly, across European bank stocks, rallying this morning, 2.5%. The context is you've seen double-digit losses for that sector over the last week. Here's Credit Suisse, though, firmly in focus for us today, just gaining 0.5%. We continue to watch the bonds and the credit default swaps of this bank. UBS and Credit Suisse both pushing back on the idea that they will merge. Coming up, we take a deep dive on Credit Suisse and the banking sector. Stay with us for our special. This is Bloomberg.
somebody says, I want to be, and a person has an impact on society, what would you recommend that somebody do to train themselves and to work their way up to be somebody that's impactful on society?
Well, I think the first thing you've got to believe in something that you really care about. You know, I've been fortunate that over the course of my career, I've come up with things that have mattered to me, and I've pursued them. You know, the best advice I ever got was from Mike Bloomberg. And he said to me at one point, he said, show me somebody who's never lost, and I'll show you a loser. And I believe that if you believe in something, go after it, take risk. Obviously, they should be smart risks, but they should be around things that you really care about.
So you would see your legacy as being actually target ALS and helping to moderate the impact of ALS, if not curing it.
That's my final legacy. I'm proud of some of the other stuff that I've done as well. Transformation of New York after 9/11. I'm also incredibly proud of a lot of the companies we created at Sidewalk. But I feel like I've done a lot.
DOJ or other authorities
could face bigger challenges next.
Was going to keep rate World Cup. This is a 3
as the economic picture down. The BOK is getting ready to make a decision.
Welcome to our special coverage of the heightened pressures on the global financial system and the banking breakdown. I'm Francine Lacqua here in London. Now, more turmoil in the financial world this week with Credit Suisse front and center. We'll unpack the broader pressures in the banking system and what lies ahead in terms of regulation and consolidation. Now, the storm swirling around Credit Suisse dates back years. In March 2021, the lender was hit by a double dose of bad news following the collapse of Greensill Capital and then Archegos, which left Credit Suisse holding the bag on billions of dollars of losses. Now, the Zurich-based bank has also been rocked by legal trouble and instability in the executive suite, with 3 chief executives and multiple chairmen since 2020. Some investors have had enough. Harris Associates, of course, the biggest shareholder in the bank, last month saying it has sold its remaining stake, ending about 2 decades of ownership. Now, the question now is, what will it take for Credit Suisse to break down the downward spiral after this injection of capital and, of course, the regulators stepping in? Bloomberg has spoken to current and former Credit Suisse executives about the bank's performance over the past few years.
It's too premature to make a prediction now for 2021. It's clear that 2022 will be at lower levels than last year.
Thomas and I came to the conclusion that it is better to have new leadership. We were, as a company, under fire, and he, as a CEO, was under fire.
We want to go through the transformation of the next 3 years. It will become profitable definitely from 2024 onwards.
When you are where we are, with the historically low on the share price, with a great management team, with a plan that is convincing the market, and the market, our shareholders believe it.
The results are unacceptable, obviously. We said we are going to make a loss, unfortunately, this year. A lot of the restructuring costs, baked into the transformation are coming in 2023, before we see a lot of benefits.
In a moment, our expert panel, but first, Bloomberg's Oliver Kirk, who's in Zurich. Ollie, the SNB has provided a lifeline to Credit Suisse. What options does it leave going forward?
That's right, and you picked the picture there, Francine. So a bank in trouble into a bank in crisis this week. SMB trying to stem the flow, and so much has returned some stability and calm to this market in the short term. The question is, how long will it last? That will come down to clients. Will clients stick around? Will counterparties stick around? Will staff stick around? And at the end of the day, the market will be the dictator in this. It's what has triggered this entire crisis. And a lot of analysts out there are skeptical that Credit Suisse can keep going as a bank as it is formed today. There is, of course, behind me, Credit Suisse Suisse, they're looming in the distance. You see UBS, JP Morgan's base case or most likely outcome is a takeover. But the second you start looking at what that actually looks like, some of the logic falls apart. UBS is trying to push into the United States. Credit Suisse does not offer them a lot there. There's a lot of client overlap. They do not necessarily have the same risk appetite. UBS, according to our reporting, may not want the same kind of risky clients that Credit Suisse has. And then there's another question of overlap, antitrust, and also the Swiss government. This will cost jobs potentially. And then the last question for me is, how much has UBS already benefited from the fallout of this week? How much of client flow and migration will there be? And that's a question that I think we'll get the answer to over the next couple of weeks.
Ollie, thank you so much. Ollie Crook there, setting the scene. So to our expert panel, we have, of course, our global team across Bloomberg that's been keeping an eye, a very close eye, that's been breaking news, actually, on Credit Suisse and other European banking system and banking stories. Joining us now, Bloomberg's Marion Haltefmeyer, who's been on top of the story from the very beginning, Jan-Henrik Forster from our M&A team, and Bloomberg's opinion global banking columnist, Paul Davies. So thank you all for joining us. Marion, let's start off with you. When you look at the chief executive and the team right now, is the only strategy that they can do is stick to what they have said, the 3-year plan, and hope that clients and deposits stick around?
There is a lot of hope, yes. I think the signs that we're getting and the public messages that we're getting from the executive team is, we have our plan, we're sticking to it, and, now that we've resolved the liquidity questions and the market panic, at least in their view, this gives them a bit of breathing room to actually continue on their plans and accelerate their plans as and where is possible. That being said, you asked them a couple days ago whether the shareholders and investors are going to have patience for that, and it's looking like that buffer zone of patience is increasingly decreasing.
Yeah, Jan-Henrik, how involved at this point is the government in trying to find a solution? The government, but also regulators. They can't force anyone to break up, but is this ultimately the only thing that the bank can do?
That is true. They can't force UBS to buy all the free float of Credit Suisse. That's impossible. I can tell you what we know, and that's really not much. All options are being considered by the government, i.e. the Swiss National Bank, FINMA, and also the finance ministry, right? One option is obviously you try to ask UBS, can you buy this and fix the problem? Or you find, under Swiss TBTF regime, you find a solution for the Swiss business. We understand that both banks are against any forced measures here, and that's really the status quo. So we probably will learn more over the weekend. I guess the liquidity line bought time, and I think the market also knows it's very difficult to bet against the Swiss National Bank, right?
Yeah, certainly. If they're the ultimate backstop, a lot of people maybe won't take them on. When you look, Paul, first of all, congratulations on all of your columns. There's something that stuck, I think you wrote that 2 days ago, saying, look, at this point, it's faith, not fundamentals on Credit Suisse. How do you see this playing out? What options do they really have?
Well, I think, the acute phase is past now, in the sense of, a sort of a real feeling of imminent crisis due to the kind of the liquidity that's been added. And where we are now is back to the kind of the problems of, the longer term profitability issues, how they restructure this bank, what it looks like going forward, and getting, investors particularly in the stock market, but also in the debt markets as well, to understand the story and be able to kind of, price it and model it properly so that they can, make a proper decision about, where and whether to buy the shares and the bonds and so on. And that's really crucial for stabilizing the business and putting a floor under the stock and bond prices.
Marion, any insight into actually what happens over the weekend? I'm sure that there'll be open channel of communications between the regulators, the policymakers, and everything like that. But is it a timeline? Is it a very short timeline in terms of trying to shore up this bank even more, or could it take months?
That's really unclear, Francine. I think what we're going to see in the next 48 hours and over the weekend into next week is the executives are certainly going to be working full speed on figuring out what not specifically the lifeline gives them, but more prominently, how the panic of this week has affected their business. So, you'll remember back in the fall when there was a lot of panic and questions around the solidity of the bank and their ability to restructure, there was a resulting 110 billion of outflows from wealthy clients. So we'll have to see whether some kind of reaction like that has happened this time around again, and what that means for their business going forward. You know, talking to people on the ground and in the bank, it's frustrating. They've had to deal with a lot of this bad news, and that makes talking to clients very difficult. And so whether or not that means business they might have lined up and now has vanished can come back or not.
Yeah, it's very difficult, I guess, you know, if they can only stick to the strategy, try to keep staff, try to keep clients. Paul, one of the other, I mean, if you're a depositor and you have so many options, even if you're not worried about liquidity, even if there's not a fundamental problem, why would they stick with the bank?
That's a very good question. I mean, I think that, you know, some of the assets and deposits that people will have with the bank, you know, you can't just take out straight away. You'll have time deposits, you'll have collateral for, you know, other trades that you are doing as a wealth client, and so on and so forth. So, you know, there's some natural breaks on this, and I think one of the things that they said in terms of their, you know, how net assets were moving now is like, you know, the flows have stabilized a hell of a lot, and I think they're probably seeing still some, you know, deposits that are time deposits that are maturing, you know, roll off and the money not coming back. But you know, yeah, it's a tricky decision, I guess, to take at the moment if you're a client.
Yeah, and if you're a regulator, so even if you're maybe looking at all options and trying to, if not push, coerce, you know, the two big banks, Jan-Henrik, to come in place, I mean, this has huge systemic issues. Does the regulator even want a super Swiss bank?
Well, if we look back, basically at the regulation since the financial crisis, it was all about, we don't want banks with too big of a balance sheet. Then the second point is really Switzerland wants two global banks, right? And also think about, you know, kind of the cultural issues here, right? Credit Suisse and UBS have been arch rivals. They don't want to merge. They didn't want to merge. And I think that's something you have to consider in this context as well.
But Marion, and maybe to Jan-Henrik as well, I mean, does this touch the reputation of, you know, the Swiss banking system that for many years was held in high regard?
It does, and I think that, you know, across the banking industry here, it is having an effect. I mean, you know, rival wealth bankers are also having to explain the situation in Switzerland to their clients. I mean, it has put a little bit of a not a full stigma, but a little bit of questions around Swiss banking, and it doesn't look great. Obviously, the Swiss regulator is trying to show a force and saying, you know, we know how to handle our banks. Look, we have this liquidity line. We are talking with Credit Suisse. We are talking with UBS. But it does cause a little bit of a question of, you know, how stable is Swiss banking in the future going forward. As Jan-Henrik said, they're a very important banking country, and they like to have their two Swiss national champions.
Yeah, and at the same time, it also, of course, raises questions about Michael Klein's boutique, Credit Suisse First Boston. Paul, what did you learn this week in terms of the banking system? I mean, this was, I guess, fear out there. Could it happen? And we know that Credit Suisse has had huge problems, but are you worried that it could happen elsewhere?
Do you mean in other European countries, or
in another bank?
Yeah, I mean, I guess we're living in these quite sort of, you know, tense times. It's probably more in the US than in Europe, but we've obviously had, you know, an awful lot of quantitative tightening underway, you know, money sort of leaving the system. And I guess, you know, what we're seeing in the US is a problem not necessarily of not enough money, but just money not being in the right places. It's a kind of a distribution issue. And, you know, perhaps, I mean, maybe you could start seeing some of that in Europe elsewhere, but I don't think, it doesn't seem to be on the cards. I mean, it seems to be still, you know, there's a lot of liquidity around, and we're not seeing, I don't think, yet anything like the same sort of issues of, you know, sort of deposits drifting from some of the smaller banks to some of the larger banks.
Yeah, I wonder whether it does mean that anchor investors, large investors, shareholders will maybe speak a little bit less given what happened with Saudi Royal Bank this week. Thank you very much to our wonderful Bloomberg team panel. And of course, they're the people that have been breaking the most news on this story. Bloomberg's Marion Halftermeyer, Jan-Henrik Forster, and Bloomberg Opinion's Paul Davies. Coming up, the banking crisis spreads. We'll speak to the NatWest chairman, Howard Davies, about the resiliency of the European banking sector. That interview is up next, and this is Bloomberg.
everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
They say that all press is positive. That isn't the case for Credit Suisse, which has had more than its share of bad headlines. In March 2019, it emerged that Credit Suisse had hired private investigators to spy on a former employee it suspected of taking its clients.
Our shareholders have been extremely robust. If you look at the share price, it's not the share price of a company in crisis.
The collapse of supply chain financing company Greensill Capital embroiled the bank. Swiss regulator FINMA said Credit Suisse had made, quote, partly false and overly positive statements when it marketed $10 billion of funds to clients as safe investments.
I'm actually confident that we will come out stronger.
Soon after came Archegos Capital Management. Its collapse brought Credit Suisse $5 billion of losses and saw executives fired. It also found itself the first Swiss bank to receive a criminal conviction tied to a cocaine smuggler. Efforts to reassure investors ran into problems.
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
That saw FINMA open another investigation when the bank reported those outflows had continued. After the collapse of Silicon Valley Bank, investors are now eyeing others for signs of weakness. With Credit Suisse, they're not liking what they see.
A look there at some of the problems Credit Suisse has run into the recent years. Now, the crisis at Credit Suisse is raising questions about the state of the European banking sector. Joining us now is NatWest Chairman Sir Howard Davey. Sir Howard, thank you so much for joining us. When you look at the concern of the banks that started in the U.S. is now infecting, of course, Swiss banking, are you confident that there's no systemic risk, that actually whatever happens, that the financial system is strong enough to withhold it?
I am pretty confident, and I think the reason for that is if you look at the differences between what's happened with some US banks, not all of course, and what's typically the case in Europe, you see some things that are the same, but some things are very different. The one thing that's the same, of course, is that we've all dealt with a long period of very low interest rates, followed by, or accompanied by quantitative easing, and therefore a lot of cash swishing around the system, and then followed by a gradual tightening, or quite a rapid tightening of interest rates, and that's caused, some grinding of gears in the financial system. But the difference is, so that's been the same in Europe as well as in the US. The difference is that in the US, in many cases, banks seem to have invested in bonds. Loan growth was relatively robust in the US. And then what started to happen is deposits began to flow out of the banking system into money market funds and elsewhere. In Europe, we've had very low loan growth, actually. People have typically put their money in cash, not in bonds. And we haven't had the scale of deposit outflows that they've had in the United States. So European banks are typically very liquid, sitting on a lot of cash and not sitting on potential losses of holdings of long-term bonds, which is apparently what has caused the problem for SVP. So the situation is really generally very different in Europe from the United States.
But Sir Howard, so how do you explain the Credit Suisse crisis and the fact that it has impacted all European banking stocks?
Well, I don't want to comment on the specifics of Credit Suisse. I mean, there is there is honour among bankers as well as among thieves. Obviously, Credit Suisse has had idiosyncratic issues, and I don't think people could sensibly read across from that one particular bank to the rest of the banking sector. So what I can tell you is overall, the European banking sector remains strongly capitalised, and it remains very liquid. And we have not seen the kind of deposit flight that is causing problems in the US. We've seen some shift from non-interest-bearing deposits to interest-bearing deposits, but typically within the banking system. So that, you know, reduces your net interest margin a little bit, but it doesn't cause a liquidity issue.
Does it mean, though, that regulation could change even in the UK, and that if Europe is actually better protected in terms of capital, which you've explained very, very sensibly, how do these crises, though, change the European banking landscape and the UK one in coming months and years?
Well, I think it would be a false analogy to say that because of regulatory difficulties in the United States, we should tighten over here. The big thing in the United States seems to be that they exempted smaller banks from some of the regulatory requirements, notably from stress testing. That, I believe, was an error. Many people said so at the time. Over here, we have a very rigorous stress testing regimes whereby we're required to model the impact on our bank balance sheet of a significant rise in interest rates, for example, which would expose the issue that seems to have done for SVP. So I don't see why we need to change that. We need to carry on doing what we've been doing. There are in Europe as well, or the UK anyway, some increases in capital in the pipeline as a result of Basel 3.1, as we call it in the jargon. And so I think perhaps that will go ahead. But I honestly don't see that this causes us to think that we need a major review of the European banking regulatory scene, where banks are still pretty strongly capitalized. You know, we have about 14% core tier one, and we've passed our stress tests well. So I don't honestly see what it is that about this crisis that would tell us I need NatWest a different regulatory regime.
Given the speed at which central banks actually stepped in with offering either credit lines or guaranteeing deposits, is there an assumption that actually central banks will always be a backstop?
Well, some of us are a little bit nervous about the blanket deposit guarantee. I mean, this has caused now a significant unlevel playing field because, in the US, they had $250,000 guaranteed. Canada, it's $73,000 guaranteed. And in the UK, it's £100,000. And typically, that's the rate in the rest of Europe. So now there is a major asymmetry with apparently US guarantees across the whole banking system, which most people would say, and certainly I would have said when I was a regulator, was generally a bad message because it removes market discipline for very large depositors. So personally, I'm not really very happy about that as a general principle, and I very much hope that we don't have to go that way in Europe.
Do you think we'll have to go that way in the UK? And of course, what you're talking about is a moral hazard. What's the longer-term effect of a possible moral hazard?
Well, I don't see that in the UK. I think it would be a panicky reaction for which I don't see a justification at this point. As I've said, we haven't seen large-scale deposit outflows from the banking system because people have had confidence in the liquidity regime, and we disclose our liquidity rates regularly, and in the capital regime, and in the stress testing regime, and of course also ultimately in the recovery and resolution regime if things get really bad. So I don't quite see why we would need to alter that regime at the moment. Now, all bets are off sometimes. You have to recognize that sometimes situation overwhelms you and some of the principles you have to be temporarily mislaid. But at the moment, I don't think we're there.
Sir Howard, I know you worried about shadow banking when interest rates go from 1% to 5%. Is that still your main concern? And is there anything that central banks could do, slowing interest rate hikes, or regulators need to look at?
Well, I'm a bit nervous about the change in interest rate policy because, after all, the central banks are supposed primarily to do to deliver interest rates which will be compatible with their inflation target. And I think once you get to a position where the central banks say, well, we've kind of suspended our inflation target because we're worried about the small bank in California, I don't think that sends a particularly good message. That's likely to create more uncertainty and nervousness overall. So I'm not keen on the implications being seen to overturn monetary policy principles. I don't think that's a good way to go, actually.
Thank you so much for your time today. Sir Howard Davies there, the chairman of NatWest Banking Group. Now, the events of the past week have certainly given rise to some longer-lasting questions about the future of the banking sector on both sides of the Atlantic. For more, let's also bring in Bloomberg's managing editor for EMEA Finance, Michael Moore. Mike, I know your team has been working relentlessly on scoops, trying to get the first opinions out. What happens, longer term? What happens in the next week and the longer term? What are some of the big questions that investors should be asking themselves now?
Yeah, I think you can approach this from the investor perspective and the regulator one. Howard Davies talked there about you might see the regulatory system that's already in place being expanded to more banks and smaller banks. The assumption for a long time was these small banks, if they went down, it wouldn't have that much of an impact. But we've seen, in the U.S. with Silicon Valley Bank, we've seen here in Europe with Monte de Paschi, these banks, while they're not globally systemic, they might have a particular importance in one region or one industry. So I think you might see more regulation of those smaller firms.
Yeah, and of course, Credit Suisse, also the concern was that it was so embedded. Now, this all started on Thursday morning after we spoke to the Saudi National Bank chairman, and this is what he told Youssef Gameldin about raising capital.
Absolutely not, for many reasons, outside the simplest reason, which is regulatory and statutory. We now own 9.8% of the bank. If we go above 10%, all kinds of new rules kick in, whether it be by our regulator or the European regulator or the Swiss regulator, and we're not inclined to get into a new regulatory regime.
This was actually on Wednesday, and then he spoke to another media on Thursday saying, look, the panic was completely unwarranted. How did you live through this? Was this panic, fear that led to this, or was it the shareholder misspeaking?
I think it was jittery markets. I think, there was a lot of uncertainty. I don't know that many people expected the Saudi National Bank to take a 25% stake. It removed one possibility of a quick capital raise, but I think it showed just how much concern was out there, because this is something they had said when they took the stake was, we want to keep this below 10%. So I think it was Credit Suisse, faced this in October as well. There was some concern and it escalated quickly.
Michael Moore, thank you so much. As always, Bloomberg's managing editor for EMEA Finance, Michael Moore. That's it for our special coverage. We continue to bring you all the developments over the weeks ahead and what it means for the health of the global financial system. This is Bloomberg.
World War II into the 1950s, you mentioned that the Fed had imposed yield curve control, basically to finance the wartime deficit. They were trying to move off of that. These are all sort of familiar themes to anyone in 2022, but why was that difficult for them?
Well, so let's get a sense of scale, right? Mm-hmm. So in 1941, there's about $40 billion worth of treasuries outstanding. In 1945, there's about $240 billion worth of treasuries outstanding. So that's about double the pre-war GDP. If you scale that to 2019 and say, okay, COVID expenditures on the scale of World War II, that's about $40 trillion. And the question is, who's going to buy it? Yeah. And
so what we're dealing with is kind of nothing. We got it.
In that context. And so that's where I guess the analogy breaks down. But it's a very difficult problem, which is who's going to buy the equivalent of $40 trillion today in debt?
The top names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg.
This is Bloomberg.
I can reassure the members of the committee that our banking system is sound and that Americans can feel confident that their deposits will be there when they need them.
They knew what they needed to do, and I think they've proven that they're willing to respond quickly.
We see pretty much every half day another measure being put in place. So we do think that over the coming days that things will come down.
In actuality, this rise of uncertainty has been in place for about 5-6 years. If you're not concerned, you're not paying attention in this kind of marketplace.
This is Bloomberg Surveillance, early edition, with Anna Edwards and Matt Miller.
It's 9 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. A tumultuous week draws to a close. The market welcomes a $30 billion rescue deal for First Republic Bank, but Bill Ackman isn't impressed with the move. The ECB delivered a rate hike. Now all eyes are on the Fed's meeting next week, with traders debating whether the central bank will follow suit. Meanwhile, in Switzerland, there are rumblings of a combination of Credit Suisse and UBS. Our reporting suggests both banks are pushing back. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And Matt, what an incredible week it's been. A little bit of confidence returning to markets, it seems, this morning. Well, yesterday and this morning.
2 weeks, actually. It just dawned on me that my COVID experience is much like the banking crisis. You know, it hit hard at first, and it was a surprise. I came back after emergency measures rescued me, but then an old case came back to haunt me, and I needed the SNB to step in. In any case, what we're looking at right now is another gain in futures. After the resurgence that we had in equities yesterday, we're almost back to 4,000 on the cash trade, and it looks like we could get there at the open this morning as well if we continue this positive move. The U.S. 10-year yield coming down 1.5 basis points, but back down at 356 right now. Of course, we, over the past couple of weeks, have been up 50 basis points and then back down. We do see a big jump in gold. One of the things that we've noticed is, or that I've noticed is, you haven't seen a huge run to the perceived safety of the U.S. dollar. You didn't see us going back up to new highs on the Bloomberg Dollar Index or the Dixie. That really hovered around its usual levels, but you have seen investors reach to safe havens like gold, or, dare I say it, without being flamed on social media, like Bitcoin. 26,000 and change after the banking, I think we can use the word crisis, that's happened over the past couple of weeks has only driven Bitcoin higher, which is fascinating. Take a look at what's going on in Asia. They had big gains there overnight on the MSCI Asia Pacific, up 1.33%. After the multiple bailouts that we had. I mean, you name it, right? FDIC, Federal Reserve, SNB, and now all the big banks on Wall Street. That's driven the Hang Seng up as well, 1 2/3%. You've got the Nikkei that closed up 1.2% higher. And the dollar is weaker against the yen right now. You can only buy 133 yen for the dollar. That hasn't really moved much at all during these past couple of weeks of crisis. Take a look also at some of the headlines that we're getting across right now, and China cutting the triple R, and that could boost assets even further.
Yeah, absolutely. This equivalent to sort of putting in more money into the system, essentially. So not requiring banks to keep so much in reserve. So seen as equivalent to sort of monetary stimulus. China cutting its reserve requirement ratio, triple R, the amount that banks have to keep in reserve and can't lend out, cutting that by 25 basis points. So a quarter of 1%. So really interesting to see the central bank there in China. Concerned enough, perhaps, what about their own economy or the global story, that's what they're doing at this point. It's an interesting development. We will no doubt dip into that story later on in the program as well. European equity markets, even before that news, were pretty positive. The map was all pretty green, even if we were off our earlier highs, given the news flow around First Republic and some of the, a little bit of calmness returning to the banking sector. The energy stocks doing really well. We are down by 10% on oil prices month to date. So that's an interesting one to watch in terms of the Chinese development story, of course. And so energy stocks not focused on that, focused on the rebound in oil prices that we're seeing this morning. This is recovery in the banking sector. We saw some of this yesterday, a little bit more of it today. We are off highs, though. This was higher around half an hour ago, but we're up by around 1.6% on the banking sector. Here's one of the banks, doesn't sit within that sector, actually sits within financial services, but it is another bank in focus, of course, the bank in focus here in Europe. And the stock is down now by 3.6% after actually starting in the green this morning. And I just put in the euro, 106.57, as we see equity markets showing strength, and so money coming out of the dollar and room for the euro and the pound to rally this morning. Then,
if an extra 50 billion francs won't help you, what will, right? Well, here, stateside, the biggest banks on Wall Street have agreed to deposit $30 billion with First Republic in an effort to stem the turmoil that sent depositors from that bank fleeing. Sonali Basak, our global finance correspondent, joins us now with details on the latest bank rescue package. Sonali?
Listen, this is certainly a historic package. You think back to the panic of 1907 when the last time the banks got together,
I often think back to the panic of 1907.
Do you
Yes,
really?
Of course.
You have a strange mind. But anyways, remember, if it was just that, it would be one thing. And remember, this is a really quite historic package here. They say it started with the 3 J's, as the Financial Times puts it, or as our own Hannah Levitt puts it, it's the panic of now 2023. This started with a call earlier this week with JP Morgan CEO Jamie Dimon, as well as Janet Yellen of the Treasury Secretary, as well as Jerome Powell. And the idea here is that confidence put in by the big banks would start to stave some of the issues, certainly in First Republic, keeps the door open for a sale. Remember, once the situation gets more difficult, a sale also becomes more difficult. It's interesting to see how the other banks also reacted in the wake of this rescue package. The form of deposits is interesting because it's not wiping out any equity, it's not diluting anybody here in terms of the shareholder base. You saw Western Alliance spiking on the back of this news. You saw PacWest not get the same amount of love in the stock market on the heels of this. Remember, the bigger issue here is not just First Republic, but any potential fallout and spread across the financial system. You know, if you think back, some people have drawn, Anna, the parallel to the savings and loan crisis. Many more banks failed. We saw 3 in a week, and then this big rescue in the United States. But the scale and the speed at which all of this happened is certainly unprecedented to most of the people who were involved in a lot of these
Just
crises.
like Matt, I do think back to 2007 fairly often. We'll leave 1907 to the historians, though, Sonali. But let me ask you about how this is all being received by investors, what they're doing with First Republic in particular, because you see there the pre-market trade. After hours, this was actually a stock that weakened quite a lot, as if maybe the market not sure about some of the details here, and other voices are concerned about what this means for the rest of the banking sector. Bill Ackman, for example, is worried about contagion from this into other banks.
There's been the worry about contagion, certainly, and I think the other issue that's underpinning what Bill Ackman had to say is that every time, Anna, one of these rescues happen, the question from the market comes, is it enough? When the next issue happens, how is that bank saved? You've seen a number of measures, extraordinary measures, really be taken by the Federal Reserve already, and now the banking system itself. What happens to the next bank? I think, interestingly, in addition to the stock price movements of all of these firms, is this idea here that a record amount of money was used to borrow from the discount window from the Fed, and the 2 facilities set up by the Federal Reserve in this latest crisis has already been tapped at a significant scale. It's hard to tell where this is going. The government and the other banks are telling you they'll do what it takes. That's really what all of this comes down to, is the messaging. But what happens next time, and then the next time, and then the next time? That's the question.
All right, Sonali, thanks very much. Sonali Basak there talking to us about the latest this time private bank rescue package put together. Now, all banks in the U.S. have borrowed a combined $165 billion from 2 Fed backstop facilities in the past week. It's a sign of escalated funding strains in the aftermath of Silicon Valley Bank's failure, to say the very least. Kriti Gupta, our markets correspondent, joins us now with more. Kriti?
Yeah, there's a lot to digest here, specifically that $153 billion that a lot of these funds are accessing for their discount window. For the record, this is not the funding program that we saw kind of kicking in over the weekend. And this is really important when we talk about it from a macro perspective, because at the end of the day, it is now being viewed as stimulative, some sort of form of quantitative easing. We'll get to that in a moment. But remember, $153 billion, nothing to scoff at there. And like I said, this is in addition to the bank term funding program that the FDIC and the FedStop used to backstop this past weekend of $11 billion. On top of that, just the cherry on top of a pretty bad Sunday, is the loans to the FDIC, $142 billion there. And as a kind of combination, this is really important because it's not just that 153 that's seen as easing. The discount window historically has been seen as something to kind of frown at, a little bit of a stigma. It looks like that stigma perhaps coming off just a little bit.
Okay, and let's move on to what all of that means for the Fed next week then, Kriti. We, of course, look ahead to the Fed's decision, and there's a wide range of expectations out there on Wall Street as to what the Fed might do. You wonder if they are having some of the same conversations, some of the same thinking as we saw at the ECB is going on at the Fed.
I think they absolutely are. And I think one of the core questions is not necessarily about the rate hike that you're potentially going to see. Remember, the market is now priced for about 25 basis points, but Wall Street kind of calls range from 50 basis points to a 25 basis point cut. So really seeing a broad increase. But I got to say the highlight call has to be from Nomura, the idea that it's not just a 25 basis point cut that could be on the table. It's also perhaps the end of quantitative tightening altogether. And this is where that discount window is so crucial. $153 billion. If you look at the Fed's balance sheet, which has slowly been coming down, you essentially see a spike back up in those assets, which tells you at the end of the day, in some form, this is quantitative easing to some extent.
All right, Kriti, thanks very much. Kriti Gupta there talking to us about what to expect from the Fed, what we've seen from the Fed. It's been a roller coaster week, not just for U.S. banks, but of course for Credit Suisse. The Swiss bank and UBS are said to be resisting the idea, as usual, of a forced combination that some in the industry say would boost investor confidence. Bloomberg has learned UBS is reluctant to take on the risks related to its smaller rival. That's been the case for some time now. Joining us from Zurich is Bloomberg's Oliver Crook. So, Oliver, where do things stand this morning?
Right, Matt, let's pick up on that UBS and Credit Suisse story in a little bit. First, let's just deal with this morning and pick up with some of the themes that you've talked about. You talk about the 3 Js. Let's not forget the 4th J, Thomas Jordan, who injected 50 billion francs to stem the bleed here in Credit Suisse. The question is also, is it enough? And that is something that we're going to have to see play out over the next couple of days. How will clients react to what has happened over the last few days? How will counterparties react? And all of this will dictate, and of course, a market that has been basically the autocrat in this. It is a market-driven story. It was not a lot of news that precipitated this, that brought the stock down, and that forced the S&P into the market. And the question going forward is it enough for Credit Suisse to remain as it is today?
Right, and so what does happen from here to Credit Suisse? We've talked about the possibility. Your thoughts then, Ollie, about some kind of tie-up with UBS, even as the two businesses themselves push back against that?
That's right. I mean, it's important to say what Credit Suisse has said. They're continuing to stick by their turnaround plan. They're hoping, I think, that the liquidity here will be adequate in order for them to get the amount of time and breathing room to push this forward. But a lot of analysts are skeptical of this. And so JP Morgan out again saying that the most likely scenario is a takeover from this bank here, UBS, to this one here, Credit Suisse. And this looms large today over this. But when you start scrutinizing this, in addition to the reporting that we've had, there are some issues that start to arise. For UBS, their priority is expansion into the United States. Credit Suisse does not bring them a lot on that. And then there's also the question of overlap. The overlap of clients, this brings up all kinds of antitrust issues. Also, if there is a takeover, does the Swiss government want that? That could cost jobs. And then bring to that also the risk profile that Matt just mentioned. You know, does UBS have the same risk appetite for some of the clients? The answer also, according to our reporting, is no. And then the last question for me is what has the impact of the last couple of days been in terms of client flows from Credit Suisse to UBS? That is a question that I think we'll see answered over the next few weeks.
Absolutely critical question as well. Oliver, thanks very much. Bloomberg's Oliver Crook reporting live from Zurich on the turmoil at Credit Suisse. Now, let's get more on the headlines that just crossed the Bloomberg terminal. China is going to cut the reserve requirement ratio, the so-called RRR, by 25 basis points. That is stimulative, of course, of the Chinese economy. So why are they doing it, and what will the result be? Joining us to talk about this is John Liu. He's Bloomberg's executive editor in Greater China for Greater China in Beijing. So, John, tell us what we know.
Well, what we know is that reserve ratio requirement is going to be cut from next week, March 27th. It's being cut by 25 basis points. As you said, that will be stimulative for the economy. It will release more liquidity into the system from those commercial bank reserves that are currently held at the central bank. This is happening after the economic data that we got for the month of January and February. It showed a recovery, but it was weaker than many had hoped for. And we've had some more high-frequency data for the first couple of weeks of March, showing things like car sales and home sales have not done as well as people had hoped they might. And so it does look like that the authorities are taking steps now to try and make sure that there's enough liquidity to keep that rebound going after the reopening post-COVID zero.
John, it's interesting to see policy moving in the other direction in China then, compared to other parts of the world. Certainly many Western economies still hiking at this point. This is going to be something that has an impact on Chinese assets.
It should. I mean, throughout the sort of tumult that we've seen in the last week, Chinese assets have stood out for being relatively stable. I think that the country here, the economy here being on a different part of the cycle is part of that. It being relatively insulated from global financial markets is another part. I think signs that the government is ready and willing to do more to propel growth, I think that will be taken positively by the markets here.
John, thanks so much. Bloomberg's John Liu giving us the latest there on that surprise news from Beijing. Coming up on Credit Suisse, Joost Beaumont joins us, ABN AMRO, head of bank research. What does he think the future looks like for the Swiss lender? We will also talk to Beata Manti, Citi's head of European equity strategy. How much will the rest of the banking sector recover? How much does the rest of the European equity market recover from recent selling? Plus, the end of an economic era. Today's big take story looks at the chaotic week that was and where we are headed next. Look for that online or on the Bloomberg terminal. This is Bloomberg.
As governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
Breaking news first.
Credit Suisse is a big deal.
Too big to fail, but also too big to be saved.
I'm wondering whether you would be assisting further.
Absolutely not. We're not inclined to get into a new regulatory regime.
The Swiss National Bank would provide liquidity if needed.
Increase the three key ECB interest rates by 50 basis points.
First Republic down about 30%. We're on watch negative for Western Alliance.
This is the tip of the iceberg. For the latest on the banking industry turmoil, keep it tuned to Bloomberg TV and radio.
In Europe, we have strong supervision, we have strong capital, and we have solid liquidity positions. And as the Vice President said, exposures are not concentrated. And based on the work that has been conducted by the SSM, we don't have similar occurrence as the one that occurred in California, for instance.
That was the ECB President Christine Lagarde talking about the strength of the European banking system. The focus for Europe has been very much on Credit Suisse this week. Let's talk about the fate of that bank and others. Joost Beaumont joins us, Head of Bank Research at ABN AMRO. Joost, very nice to have you with us. So there's the Credit Suisse story to talk about. There's the latest efforts in the United States to shore up the banking sector there. Let me start with Credit Suisse. CDS, of course, we saw a real blowout in the cost of insuring against default on Credit Suisse debt during the course of this week. Some slight normalization, although that would be going too far on that number, but not really very much. And so still an elevated level of concern about this business, Joost. Where does this end for Credit Suisse? What do you think happens from here for this business?
Yeah, that's of course the $1 million question. And indeed, as you said, some calm has been restored for now. But it is, of course, the most beleaguered bank in Europe at the moment. But I think that the regulators were right to step in to say the bank is well capitalized. It has a lot of cash at hand. They can get liquidity at the central bank. So for now, it should just be able to operate on a standalone basis. Of course, it's all about investor confidence, which is not that strong, of course, to put it mildly. And I think what triggered this week's actually events was the announcement in the annual report about the weaknesses in the finance and control, and then the Saudi National Bank saying we don't want to put more money in. But if you listen to that carefully, basically they mentioned that they are not able to do so, that it's more like from a regulatory perspective, so it has nothing to do with their faith in the bank. But yeah, if confidence
yes, we certainly listened to the detail. Yeah, we listened to a lot of detail there from the Saudi National Bank. Talking to our colleague, in fact, Yusuf Gamal Al-Din over in Saudi Arabia. From one SNB to another, though, they certainly have a lot of support from the Swiss National Bank, from that SNB, and from FINMA, the Swiss regulator. Both of them have looked at the capital levels of this business and felt able to step in. That's a show of confidence. Does that work to convince the markets that this business then has an independent future, or do you see a tie-up with UBS as likely?
I think with your report earlier in the news, maybe a tie-up with UBS will be quite difficult. Of course, it needs approval of I guess, Swiss government. Maybe you don't want too big of a bank, so it might hurt also competition in the country. So that scenario might be unlikely, and but still. There's a long road ahead for Credit Suisse. They are, of course, in this strategic review. They're still loss-making, and only in 2024 they expect to be profitable again. So that's still a long and I guess a bumpy road to get to. And the question is, will it indeed do that alone, or will it in the end be maybe taken over by someone else? But I want to stress that if you look at the balance sheet itself of the bank, they have a lot of loans which are collateralized. So basically the quality of their assets is not an issue. It's more the confidence in executing the strategic review, etc.
Joost, I was wondering about just that. You know, this past week, a lot of Americans have been shocked that banks fell below book value in terms of their price. I wasn't as surprised, having covered European banks for the last 6 or 7 years. That was pretty normal. However, I have never seen a bank fall to this level. Credit Suisse was trading at just 0.15 times book value. What does that mean about maybe the faith that you have in its book value?
It shows that investors do not have a lot of faith in it, I think what is the key is confidence here, and if you get in an annual report a statement that maybe your controls are weak, then investors might start to doubt whether the numbers in the whole annual report, how you need to read these. So. The only thing Credit Suisse can do is step up its efforts to turn around its business. Of course, it can benefit heavily from the rise in interest rates, from net interest margins that are positive, and slowly it should get out of the woods. But like I said, it's a very long and winding road.
I wonder about, you know, here in the U.S., it seemed that regulators were quite keen to rescue depositors. They don't want to use the word bailout, and they seem to want to zero out shareholders and some bondholders as well. Is that the case, you think, with Credit Suisse as well? If there comes a time when they really need to be bailed out beyond even the 50 billion franc rescue we've seen so far, are they going to want to penalize shareholders, which is one reason that people should keep their hands off of this equity?
I guess so. If you go to a scenario where they will be sold, if they're sold, of course, then you get some price for that. So that's a different case. But yeah, again, indeed, as an equity investor, you of course lose money if things go wrong. But I want to stress again, they have like 100 billion Swiss francs in loss-absorbing capital. They have a balance sheet of 500 billion and risk-weighted assets of around 250 billion. So in a way, they can withstand absorb quite a lot of losses before really getting into trouble. But yeah, the market is not focused, I think, on these numbers at the moment.
Joost, would you expect the rest of the European banking sector to bounce back from here, just briefly?
Yeah, bounce back is maybe a big expectation. I think what it all shows is also that the sharp rise in interest rates in the US and also in Europe is just leaving its mark on the economies, and so there might be quite some headwinds ahead of us. So. But the most positive issue is that banks' net interest margins are very positive, so they could also withstand quite some loan losses in that respect.
Okay. Joost, thank you very much. Thanks for your time. Joost Beaumont of ABN AMRO. Great to get your thoughts on the banking sector. We'll broaden our conversation. Beata Manthi joins us, Citi's head of European equity strategy. European stocks rallied so much at the start of this year. Some of that has been unwound now. Where do we head next? This is Bloomberg.
wrong, and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, oh, the hour it's off. No, it's by the minute, and then it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. A tumultuous week draws to an end. The market welcomes a $30 billion rescue deal for First Republic Bank, but Bill Ackman isn't impressed with the move. The ECB delivered a rate hike. Now all eyes will be on the Fed's next meeting next week, with traders debating whether the central bank will follow suit. Meanwhile, in Switzerland, there are rumblings of a combination of Credit Suisse and UBS. Our reporting suggests both banks are pushing back. I'm Anna Edwards in London with Matt Miller in New York. And Matt, really interesting to see that news around First Republic boosting sentiment yesterday on Wall Street, but then actually not helping the individual share price after hours. US futures not looking all that convincing from here.
No, and by the way, this is a pattern that we've seen throughout the last week and a half or so of banking crises. You get these rescues that immediately make investors feel better, and then, you know, the air kind of gets let out as the trade goes on. Let's take a look, though, first at what's going on in China, because just about 30 minutes ago, we saw a cut to the reserve requirement ratio, the so-called RRR. I've got a chart here of the offshore yuan, and you can see that the U.S. dollar had already been very weak against the Chinese currency. This is in London time, right around 9 o'clock, just thereafter London time, 5 a.m. here in the U.S. We saw that headline come across the terminal that they were cutting the RRR by 25 basis points. Then you saw a little bit more of a weakening of the dollar, a strengthening of the yuan, but it still hasn't come back to the levels we saw earlier this morning. Let's take a look at what's going on in terms of the U.S. markets. Anna, you mentioned that S&P futures aren't terribly convincing. They're only up about 0.1%, but we had a pretty great rally in the cash trade yesterday that pushed us all the way back up to, I think, 39.50, 39.60, so just under the 4,000 level on the cash trade, almost erasing the losses that we've seen this week. The U.S. 10-year yield right now is coming down about 3.5 basis points at 3.54. Of course, last week we were up over 4% across the curve, and that has been really the most dramatic volatility, or where we've seen the most dramatic volatility in yields. Gold, I just want to point out that we've seen not so much flows into the dollar as a safe haven. I mean, the Bloomberg Dollar Index is still trading, I think, under 1250, and the record last year was 1353. You have seen investors flock to gold, right now trading at 1932 a troy ounce. And for whatever reason, You've also seen investors, obviously a much smaller extent, it's a much smaller market here, but flock into Bitcoin. It's trading at over 26,000. Now, I had hypothesized last week that one of the issues you see is that when investors pull Bitcoin off of centralized exchanges, those exchanges are forced to turn their treasuries or any other dollar assets into the cryptocurrency, and that's why you see the price drive up. But in the crypto community, there's a lot of talk about distrust in fiat currencies, and hence investors going to the original crypto. Take that with whatever grain of salt you will. In terms of the pre-market movers this morning, First Republic obviously is one of the shares that we're watching very closely. Those shares right now down 6.7% amid concern that it's not quite out of the woods yet, even after the efforts that we've seen from the big Wall Street banks to restore confidence. Of course, JP Morgan led a group of banks to deposit $30 billion into First Republic for at least 120 days. U.S. Steel is a stock that's up in the pre-market almost 5% after that company's earnings per share forecast blew away the Wall Street estimate. The company now expects EPS of at least 58 cents, and the estimate was only for 18 cents. So that's pretty incredible for X. And then NVIDIA also gaining just a little over 1% right now, but those shares were upgraded to overweight at Morgan Stanley, which writes, the development of generational AI is too much of a mega trend to get distracted by tactical concerns. Anna, what do you see in Europe?
Yeah, we see a bit of catch up here in Europe. European equity markets then going higher. Matt, reference to that really strong cash session that you talked about on Wall Street yesterday. Some of that was after our close, so we have a little bit more to factor in there. I also wonder how much stimulation of the Chinese economy is going to have a kickback into the European story. We can talk about that with our guest in just a moment, and what that will do to energy stocks and energy prices. All of that will be interesting to think about. If we are seeing the Chinese economy looking at more stimulus, that is a really interesting thing to think about. But for the moment, Stocks Europe 600 up by 0.8%, and energy stocks are gaining, despite the fact month to date we've actually seen a real drop in oil prices, down by 10%. We see them gaining today as a result of the strength in various risk assets, and so energy names also go higher, up by 2.9%. This is the banking sector breathing. It's not really a sigh of relief, is it? But it's certainly not dropping right now, as we've seen a bit of a distance being put between the banking sector perhaps and what's going on at Credit Suisse, and even some reprieve yesterday for Credit Suisse, although that didn't seem to last too long. We are down by 4%. It's not 10, it's not 20, but we're down by 4% today, back below 2 on the Credit Suisse share price. So we'll certainly watch that with interest. It actually started the day, Matt, in positive territory, but has since retreated.
All right, let's talk about the effects that stock and the entire banking industry has had on European stocks with Beata Manthe. She is city head of European equity strategy. And Beata, unlike what we've seen here in the U.S., the S&P looks like it's going to end the week 100 points up on the week. The Stock 600 is still down on the week and off about 20 points over the last 2 weeks. How hard is it for European stocks to recover from this loss of confidence in the banking sector?
Good morning, guys, and thank you for having me. I think we need to put the current events in the perspective of the bigger sell-off. So remember, European equities have had an incredible ride. So Stocks 50 has been up until last week by over 30%. European banks up by 50%. So even without the latest events, we always thought that the market was ready to take some profits. And of course, we've entered all this turbulence and volatility with really the highest net longs positions, the most bullish positioning that we've seen in the past few years on European banks. So no wonder that European banks have responded in such a strong fashion to the downside. Now, going forward, of course, what we've learned through this week is that there is a transmission mechanism of tighter monetary policy. It's non-linear, it's delayed, but tighter monetary policy breaks things, as we found out in a painful way. Some parts of the market are more painful than the others. So I think the investors will try to figure out what that means for the future. And I think the most obvious focus is going to be on increased risks to recession and increased risks to the downside of the EPS of fundamentals.
Well, and you've got central banks working at cross purposes in that respect, don't you, Beata? Because as the Swiss National Bank is handing out, 50 billion francs, you've got the ECB tightening again by 50 basis points. What kind of effect does that have?
Well, it has definitely returned some confidence to the market, right? And the fact that the other banks around the world are joining the switch is comforting. But what we've seen from the ECB yesterday is, of course, that perhaps conventional monetary policy, at least here in Europe, and we think that in the US next week, the tightening cycle will continue. The Fed will hike as well as the ECB did yesterday. But there is a big question mark about the non-conventional monetary policy. The latest central bank's actions, SNB and the Fed, tells us that we are starting a really easing cycle on the non-conventional. So that should provide some support to the market and to the economy.
Okay, so maybe that's what we should focus on, Beata, when we see that the Chinese central bank, the PBOC, is cutting its RRR. I was taken by this because, of course, we're seeing central banks in the West still hiking. If we do see that from the Fed, maybe we get a pause, a wide range of expectations. But certainly in Europe, we're still seeing hikes. That's what we saw from the ECB. And the concern remains really on inflation. What does it mean for what's the European read across, I suppose, from this cut in the RRR, from this stimulus of the Chinese economy? What does that mean for Europe?
So when you look at it from the Chinese perspective, of course, the Chinese authorities are trying to boost the economy, and European equity market is the biggest proxy of playing the upside in the Chinese equity market. So we have these baskets of developed market stocks with big exposure into the Chinese market, and after the reopening of China back in October, November, these stocks in Europe have been boosted the most out of all the other regional proxies for playing the reopening. So definitely that could provide to some parts of the European market, that could provide some boost.
Yes, and it's good for European growth. Is it bad for European inflation? Does it, push energy prices higher and the like, Beata? Is that a concern for you?
That's, of course, everything is circular. If energy goes higher, that means inflation will stay longer, and that means that the central banks, like the ECB, will have to stay the course. And let's not forget about wage pressures and pressures on the core inflation. For these reasons, our city economists expect the central banks to stay the course, at least on the conventional monetary policy tightening. But of course, it will be very data dependent.
Right, staying the course on traditional monetary tightening, doing other things with other hands. Beata, thank you very much. Beata Manthi, thank you so much for joining us of Citi. Coming up on the programme, Credit Suisse's bond buyback plan. More on how the bank is looking to counter a collapse in market confidence. That's next. This is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns. compound human returns, they're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for the, if they invest for the right reasons, just keep at it.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Overall, the European banking sector remains strongly capitalized and it remains very liquid. And we have not seen the kind of deposit flight that is causing problems in the US. We've seen some shift from non-interest-bearing deposits to interest-bearing deposits, but typically within the banking system. So that, reduces your net interest margin a little bit, but it doesn't cause a liquidity issue.
That was NatWest Group Chairman Howard Davies speaking to Bloomberg earlier. And Credit Suisse is looking to counter a collapse in market confidence. The bank is poised to save about $70 million with its plan to buy back debt at a discount. Joining us to talk more about this, Irene Garcia Perez, Bloomberg distressed debt reporter. Irene, how did Credit Suisse bondholders react to the announcement yesterday of the debt buyback, and probably more than the 70 million, they were focused on the 50 billion francs in liquidity from the central government?
So we saw a mixed reaction yesterday from the bondholders that were included in the buyback, which are bonds that are ring-fenced in the case of a bail-in, an intervention of the bank. Those were trading up yesterday. But we also saw the so-called bail-in securities, which would be written off or converted into equity if the bank was intervened by the regulator. Those are trading at distressed levels, which shows a bit where the investor mood is these days.
Yeah, so are we seeing different reactions then on different bonds from what you're saying there, Irene?
Yeah, definitely. And it's interesting because Credit Suisse does have a capital cushion and also an additional tier 1 bond cushion that would be, those would be the first ones to be written off. But still, we are seeing an important reaction, a negative reaction from these bail-in bonds.
Okay, interesting stuff. Thank you very much, Bloomberg's Irene Garcia Perez. And be sure to check out Bloomberg's Distressed Debt newsletter, The Brink. That is published twice a week on Tuesdays and on Fridays, so it seems we're due another one. Right, joining us now, Paul Davies, a Bloomberg opinion columnist, of course, covering banking and finance. He's been writing extensively on Credit Suisse and the wider, so much news flow from the financial services sector. Let's start on Credit Suisse, but then I want to get your comments on what we've seen stateside as well. A lot of talk about whether we see a UBS Credit Suisse combination here. Does that make sense to you? I mean, the participants in that seem to be pushing back against this idea.
Yeah, I mean, absolutely. I don't think either of them really wants to be involved in a merger to clear this up. I mean, to be clear, that would really be a last-ditch solution. Things would have to get significantly worse from here for that to be something that the Swiss government and regulators wanted to make happen. But I mean, look, it would not be ideal. There's a lot of overlap between the businesses. The Swiss bank of Credit Suisse would almost certainly have to be spun off in some way, so you didn't have one bank completely dominating the local market. And then even with the prize asset, which would be the international wealth operations, and particularly in Asia, there would be a lot of overlap. And it's just it's very natural that when wealth businesses like that merge, clients look at having exposure that was to two banks now going to one bank, and will start to move some of their own assets again as well to get their own diversification. So it's it would be a costly and complicated and difficult thing to do, even if you really wanted to do it.
Right, okay, so that's Credit Suisse, and no doubt that we'll say a lot more about that. I just want to get your thoughts also on First Republic, because this seems like, do you call this innovation or a risk too far coming through from Janet Yellen? On the one hand, maybe innovative, get the sector together, say, look, this is something that's weighing on you all, you guys need to sort it out, all of you, club together, put some money in, and that's what they've done. Or, like Bill Ackman, you say this is really dangerous. This is spreading the risk from one bank into the rest of the sector.
I mean, in terms of the risk that's being spread to the rest of the sector, it's, you know, for the large banks involved in this, it would be a rounding error. It's kind of, I don't think that is something to worry about. I think what's really interesting here is this is a signal that there is, I mean, while there is like plenty of liquidity in the system among the banks, it's just not in the right places. We've got a kind of a distribution issue, and it's some of the smaller banks are seeing, you know, a bit of deposit flight or worries about further deposit flight coming. And that money either goes into treasuries or to money market funds and back to the Fed that way, or it goes to larger banks in the banking system. And either way, the Fed or the larger banks can sort of move it back to where it needs to be, you know, probably temporarily. I mean, there'll need to be a longer term solution here, but, you know, for now, it's just a kind of, everybody's getting together to shift the liquidity back around to where it came from, essentially.
Paul, I mentioned earlier that it seems the SNB and the ECB were working at cross purposes this week with, you know, on the one hand, a 50 billion franc rescue package, and on the other hand, raising rates by 50 basis points. But really, both of those moves seem comforting to me, right? The SNB stands ready as the lender of last resort. That's its job. And the ECB doesn't feel that this crisis is so distressing that it can't continue to fight inflation. What's your take on that, and how do you think the Fed's going to react?
Well, I think it's, I mean, you've got a different set of markets here, right? I mean, there is, you know, not any real signs of the problems that we've seen in the US coming across to the European market so far. I don't think we've seen, you know, any signs of deposits running from smaller banks to larger banks or anything like this. I mean, in terms of the balance of policy, I mean, it's a really interesting question right now, and it's really interesting what the Fed will do next. And I guess one of the ways in which I think about it is, you never quite know when the effects of all the interest rates hikes that you've made will come through, and it seems to take a lot of time. But then what we're seeing now, I think, is something a bit like they've been pulling on an elastic band, and the movement in liquidity and the rise in kind of funding costs that we're seeing suddenly hitting banks might well lead to a sudden kind of tightening of credit conditions, you know, less lending, and that's like, you know, suddenly all of the interest rate hikes we've already seen are now kind of catching up with the system, and we'll see a lot of that kind of, you know, tightening of financial conditions coming through all at once through the banking sector.
Are you expecting this crisis to get worse before it gets better? I mean, especially in the U.S., Paul, a lot of people are saying there are more banks, there are more bank runs that could happen. We could see more shut down, but there are thousands of banks here, and we have, in terms of the big banks, what looks like a very well-capitalized, very safe financial system.
I mean, we've got this issue in the US where they did sort of manage to create this sort of two-tier banking system with, you know, all the banks that have more than $250 billion worth of assets are managed as systemically important, or regulated rather as systemically important, and those below, even though some of them could have been regulated and supervised much more tightly, they haven't been. So, and this is kind of one of the things that's causing tension within the system, I think.
Paul, thank you very much. Really good to get your thoughts this morning. Paul Davies of Bloomberg Opinion joining us on set here in London. Coming up later today, Bob Diamond, the CEO of Atlas Merchant Capital, formerly of Barclays fame, of course. That's at 4:30 p.m. in New York, 8:30 p.m. in London. So certainly interesting to get his thoughts on what we're seeing in banking right now. This is Bloomberg.
investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. What a week this has been then, Matt. I was interested to see that Dick Bove, the US bank analyst, said the banking crisis is over. And it's a big question, isn't it? How far through this particular financial drama we are, what it then leads us into. We spoke to a guest in my earlier TV program who was saying this is the acute phase, and maybe we are through the acute phase, but maybe that sets us up for something more chronic, where we see actually the higher interest rates we've been talking about for so long taking their toll, by design to some degree, on the US and the global economy.
Yeah, and by the way, John Authers argues maybe crisis isn't yet the right word to use. I mean, just look at the fact that the S&P 500 is up 100 points on the week. We closed last week at 3860. Now we closed yesterday at 3960, and futures are pointing higher for the day. So although if you look at the period of the last 2 weeks, we are still down, it doesn't seem that investors, in terms of broader equity investors, really are phased. On the other hand, the bond market volatility has been literally insane. I think that word is a fair one to use right now, because we've seen the kinds of swings. Daniel Curtis, our producer in London, pointed out that we normally, statistically, would only see these kind of swings every like 4 million years. So it's pretty nuts that the two-year yield was up above 5 and is now trading down below 4.
Yeah, certainly not things you expect to see very often, and we see the unusual pretty often these days, don't we, it seems. Yeah, on your point about the broader markets and what they've done, I mean, if you look at where we are year to date, NASDAQ stocks actually now up by 12% year to date, which is quite incredible, thinking about the pressure that had been applied to the tech sector as a result of higher interest rates. And European stocks, they surged out of the gates, of course, well, around autumn last year, and then kept on rising this year. But still, year to date, Euro Stoxx 50 is up by 9% against the S&P up by 3%. So year to date, we are still in green territory, which is appropriate as it is St. Patrick's Day.
I was going to point out, happy St. Patrick's Day. We haven't mentioned it, so if anybody's getting ready to go to the office, make sure you put a little green on. I actually have a blue tie, but Jerome Powell on my tie is sporting a green blazer. I don't know if you can make that out in the HD camera.
Well, that seems extremely appropriate. That is it for Early Edition. Surveillance is ahead with Tom, John, and Lisa. More to come, of course, on the banking week that was. This is Bloomberg.
institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live, and it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Certainly need strong bank supervision in all seasons, and I think clearly this episode indicates that there's more to do on that front.
The banking system, as I would say, appears fundamentally resilient.
I think the contagion's limited, but the same impulse could cause more effects at other banks.
Credit Suisse is a much more complicated, entangled financial institution. I think that's where kind of there's more fear.
Ultimately, I would say Credit Suisse is not out of the woods yet.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. We're almost there. Good morning, good morning. One more day
Janet Yellen.
into the weekend. They're not getting a weekend. Equity futures on the S&P 500, positive 0.1% TK. In America, doing our best to inspire confidence in the American banking system.
We're trying. It is an eventful Friday. It's not the crisis Friday that we saw Thursday, Wednesday, Tuesday, Monday, but I'm sorry, this is not over this morning. And the same can be said for Europe, for our Americans waking up on radio and television. John, it's real simple. Credit Suisse deserves Friday's scrutiny as well.
And UBS doesn't want to be a dance partner. Did you see that reporting?
The reporting's
Not
been
surprising.
extraordinary. The Bloomberg team has done some really nuanced reporting. We'll get into it with First Republic Bank in this hour and through the morning. But John, I think surreal is almost where we are. None of this is in Steve Cicchetti's iconic money and banking textbook.
We certainly weren't talking about this 2 weeks ago. And here we are this morning, Lisa, reflecting on 11 banks in America depositing $30 billion into the beleaguered bank, First Republic. And First Republic, it has been a real struggle through the last week.
So here's the question, and I've been reading a lot about the moral dilemma here. On one hand, you shore up a smaller bank that is challenged by a liquidity issue with the fact that people might be withdrawing deposits. On the other hand, how much are you transferring some of that risk to the biggest banks that are systemically important? In other words, at what point are you taking a bank that otherwise would not be very systemic and putting the risk on bigger banks and then down the line, increasing regulation?
I'm so glad you brought this up, Lisa, because I think it is the morning zeitgeist, and I also think it's not that it's wrong, but I think we don't know our history of First Republic Bank taken out by Bank of America through Merrill Lynch. They got sick of it. They unloaded it through 4, 5, 8 permutations, and that, to me, basically the theme this morning to pull from the Oscars is all quiet on the deposit front. John, these aren't deposits. I'll go there right now. And on scale, this is important. Right now, the 5 gazillion that James Dimon is putting into this small shop, 0.2%, 0.002 of JP Morgan's deposits. The small doesn't cover it. This is teens weens.
Oh, drop in the ocean, Tom, and I imagine how much those deposits went up in the last week over at JP Morgan.
Huge.
We got a number for BofA.
It's 15.
That was BofA, I think.
Yeah, but you believe it's 15? It's probably
more than
30
that
or
now.
40,
More than that.
whatever.
There was $113 billion put into money market funds over the past week. That is the greatest total since April 2020.
The response from the Europeans, scathing. Have you seen this FT report?
Yeah, please.
Absolutely scathing. One Eurozone official described their shock at the, quote, total and utter incompetence of US authorities, particularly after a decade and a half of long and boring meetings with Americans advocating to end bailouts. Scathing.
You're 100% correct, and this is going to be the navel gazing as we read into the weekend. And I don't think we're staggering to April yet. We're just trying to get through March, and particularly to the Fed. Can you imagine the press conference?
I would Chair Powell next week.
I mean, does Mike Powell do monetary policy, or does he raise his hand and go, "Excuse me, is it all quiet on the deposit front?"
Hey, Bloomberg had some great reporting yesterday on what the ECB might mean for the Federal Reserve. So we were talking about it all through the morning for most of this week. Are they worried about the signal it would send if they did nothing? Jana Randau, over in Frankfurt, Germany, here at Bloomberg, fears that anything but a half-point hike would trigger panic among investors, help settle the ECB's interest rate decision on Thursday. According to people familiar with the matter, there was a real concern on the Governing Council, Lisa, that if they didn't hike, it would send the wrong signal.
And the debate was about a 50 basis point hike or no hike. There was no discussion of a 25 basis point hike. This was not about the monetary levels that you should have for a terminal rate. What this indicates, and frankly, the market response, edified their belief. I mean, right now, you are seeing stability in markets that might not otherwise be there if they hadn't necessarily raised rates in tandem with what they said and drawn a very stark distinction between financial stability and monetary policy.
Now, the best news in Europe over the last couple of weeks, hardly talked about. The Italian bond market hasn't sold off. Hasn't sold off. In fact, it rallied through some of this.
I thought you were going to say the TOTS won, but
I wasn't going to squeeze that in,
low
Tom.
Priority.
That is very much low priority this morning.
Okay.
This morning, and good morning, equity futures are just about positive on the S&P by about 0.1%. We will keep an eye on that bank for you. First Republic, it is lower in the pre-market, but now only by 2 or 3%. It was down way more than that a little bit earlier this morning. Yields come in 4 basis points. The 10-year 353.55. Crude has had a terrible week. Still south of 70, 69.57, even with today's bounce. And Lisa reflected on the ECB and what it might mean for the Federal Reserve. Euro dollar back to 106.45, positive 0.33%.
When it comes to the events in the day ahead, a lot of it is probably irrelevant because all that people are watching are the shares of a number of banks, and that really is going to be the front and focus. Data used to matter. It doesn't anymore, but if you care about it, 10 a.m. we get University of Michigan March sentiment survey. Do we see an ongoing pickup in sentiment to kind of build on the stronger than expected data that we've gotten, but nobody cares again, because that's always backward looking, and you're looking at a potential tightening in financial conditions. On the geopolitical front, and I think that this is a peripheral story, but very interesting, German Chancellor Olaf Scholz is heading to Japan today with most of his cabinet. He's going to be there through March 19th, talking about some of the national security issues. And at the same time, this weekend, Sunday night, China's Xi Jinping heads to Russia for the first time since Russia's invasion of Ukraine. Putin invited him over. Very curious to see these different alliances come to the fore. Again, peripheral, because right now, front and center is the banking system and what central banks do to respond to it.
Did you see that footage of that Russian jet going over that US drone and dropping fuel on it?
Yes.
Any other day, that'd be all we talked about the whole day.
There's so many things that have happened.
Amazing picture. TikTok's another one.
Exactly. That's what I was thinking. A lot of stories that are percolating, but it doesn't matter.
Wells Fargo just published. You're going to see a lot of this. Got a sneak peek of this from the likes of Goldman, JP Morgan, Morgan Stanley. Here's Wells right now. Recent developments in financial markets are compounding the Fed's efforts to slow the pace of economic activity, which for them raises the probability of recession. In their view, accordingly, here's the call. We look for US real GDP to contract 1.2% later this year, Tom, and into early 2024. They go on to say, as businesses pare back fixed investment spending, you're going to see so much more of that after the events of the last week.
And I think the writing this weekend will be into it is the economists working at these banks see their compatriots completely shell-shocked. They're going to have to adapt and adjust, and you're going to see that into March 31 as we look out to Q3. I think all of a sudden, July, August, September is a huge mystery for our guests.
Let's try and complete Q1. Jonathan Stubbs joins us now, equity strategist at Berenberg. Jonathan, great to catch up with you, sir. We know you liked European banks. Do you still like European banks?
Yeah, we've liked European banks for the last couple of years, and that's been generally the right place to be over in Europe. Events of the last week obviously challenge that. When we've sort of run our models and run our numbers this week and done deep dives into sort of UK and European banks in particular, We've got liquidity coverage ratios in Europe averaging around 150, 160%. We've got, the capital rebuild was painful, very painful for European banks post-financial crisis. There's a lot of excess capital. And so the banks look in reasonable shape and they're trading cheap. If you look at UK banks, they're trading on just 6 times forward earnings. So valuation is supportive, earnings are supportive, and you've got liquidity and capital buffers. So, of course, there are external risks. Of course, you don't want to only own UK European banks, but we still think there's a place for banks in a balanced portfolio.
Just one measure of this, Jonathan Stubbs, is a Standard & Poor's 500 in America after a bang-up Thursday is in the vicinity of 4,000. I think that would surprise a lot of people given the angst out there. Can you separate other sectors and their performance from the banking sector?
Yeah, I mean, if you take the S&P, take the US broadly, Tom, the US is trading on, probably back to 18 handle in terms of forward earnings. Now, you look back over 50 years, the US equity market, and I've said this on your show before, the US equity market has only traded above 18 times twice in 50 years, and both times were liquidity-fueled bull markets, late 90s and post-COVID. So US equities are still trading very rich ahead of what is a likely recession of some form, as per your discussion before I came on, alongside all these peripheral risks, the geopolitical risk, etc. The market is still rich and we're trading with risk. We think the US market in particular compared to global equity markets is trading too rich here, and we would not want to be chasing it.
A good portion of that is big tech. And I do wonder what your take is on the fact that big tech has rallied, has outperformed over the past couple of days, even as people talk about ongoing rate hikes.
Yeah, tech's really interesting. I mean, it's obviously been the lead engine of the post-financial crisis bull market for very good reasons. But the macro regime suited it. There was a growth deficit globally. Tech provided growth. QE and liquidity gave this free ride for technology. But I think what most people don't understand is that technology and US technology was actually cheap relative to the rest of the market on a free cash flow basis during that entire 10, 12-year period. It is now no longer cheap. So the US tech sector carries the same surplus free cash flow now as the S&P. And if you look at the NASDAQ, you look at the NASDAQ 100, the bigger tech stocks, their median free cash flow yields relative to 2-year rates averaged 400 basis points from 2009 to 2020. Now it's 0. So you could go into the market as an investor and get a 400 basis point yield pickup in US technology for over 10 years. Now it's 0. So the tech conversation is more complicated. Sure, at times like this, you want to own companies that have balance sheet strength, surplus cash flow. But because we got higher rates and because the macro is different, because the risks are different, it's more complicated. So maybe it's a question of pairing some of the banks which are resilient with some of the tech companies which have the balance sheet capacity and surplus cash to see this out and to build for the future. Maybe that's a sensible way of playing this.
What a week it's been. Doesn't feel sensible, any of this right now. It just seems messy, really messy. Jonathan Stubbs there of Berenberg. Jonathan, thank you. As always, the NASDAQ up every single day this week. Tom?
Really? I did not know that.
At the close on Thursday, the NASDAQ 100 is up 6% so far this week.
The character of the close
6%.
yesterday. The character of the close yesterday was stunning. I mean, it was just
incredible.
Just amazing. And I think it's a vote, to be fair to the authorities, they've ring-fenced the fear. And ring-fence, I'm going to borrow that from Neil Sauss. He worked for a Swiss bank years ago. Okay, fine. We've ring-fenced it. And now what of this into next week and into the Fed meetings? Extraordinary.
We'll get to the now what with Dan Skelly of Morgan Stanley. He'll join us in the next hour. Equity futures on the S&P 500 unchanged. That's a welcome development, given the volatility we've seen so far this week.
For now.
Bramo, don't ruin it.
I mean, come on. It's always like, who knows?
Will it stick? We'll see. It's a mystery.
Wrapped in an enigma.
Yields are down about 3 basis points, 354.68 on a 10-year from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Chinese leader Xi Jinping will travel to Russia next week. It's his first trip to Russia since it invaded Ukraine. Now, during the trip, Xi is expected to discuss China's recently released 12-point blueprint for ending the war in Ukraine, a document dismissed by most Western governments. Xi and Ukrainian leader Volodymyr Zelensky also plan to speak by video link soon.
China's central bank cut the amount of cash banks must keep in reserve in an effort to stimulate the economy as it gradually recovers from pandemic restrictions. The People's Bank of China says it reduced the reserve requirement ratio for almost all banks by 0.25 percentage points, effective from March 27th. Charles Schwab had $8.8 billion in net outflows from its prime money market funds this week. Investors are rattled by turmoil at U.S. banks and plowing even more money into the brokerage assets with government backing. Company data compiled by Bloomberg, it shows clients pulled money from 2 Schwab Value Advantage money funds, which had combined $195 billion of assets as of March 15th, representing the largest redemptions in at least 6 months. And WeWork is nearing a deal for a major financial restructuring in which investor SoftBank Group will convert about $1 billion of debt into equity. Sources tell Bloomberg the New York-based co-working company is also close to securing funding and capital commitments of more than $1 billion. CEO Sandeep Mathrani has been working to cut costs and push the firm toward profitability. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Was going to keep rate World Cup. This is a 3 as the economic picture down.
The OK is getting ready to make a decision.
From our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg. Breaking news first.
Credit Suisse is a big deal. Too big to fail, but also too big to be saved.
I'm wondering whether you would be assisting further.
Absolutely not. We're not inclined to get into a new regulatory regime.
The Swiss National Bank would provide liquidity if needed.
Increase the 3 key ECB interest rates by 50 basis points.
First Republic down about 30%. We're on watch negative for Western Alliance.
This is the tip of the iceberg. For the latest on the banking industry turmoil, keep it tuned to Bloomberg TV and radio.
Reassure the members of the committee that our banking system is sound and that Americans can feel confident that their deposits will be there when they need them. This week's actions demonstrate our resolute commitment to ensure that our financial system remains strong and that depositors' savings remain safe.
Have they done enough? That was Janet Yellen, the U.S. Treasury Secretary, testifying on Capitol Hill in front of the Senate Finance Committee just yesterday. Equity futures this morning, and good morning to you, slightly negative on the S&P 500. It isn't a drama-full morning so far. So far, so good, and let's see if it sticks. We're looking at one name, First Republic, which is only down by about 4%. I say only because it was so much worse overnight, back to about 33 in the pre-market. This was, I keep saying this too, think about where we were just last week. This was a stock last Monday, which was at 123 at the open. Big change. The development of the last 24 hours, Tom, 11 banks in America depositing $30 billion to backstop this distressed firm. So just parking deposits. And some, kind of, you think this is like recycling some of the deposits that have come into these institutions themselves over the last week?
Deposits. I mean, I get the idea. Emory Horton in a reporting this morning as it's a 120-day window. So what are they doing? Taking out 3-month CDs at 4.25%?
The interesting thing is none of them wanted to buy First Republic. None of them wanted to combine with it. None of them wanted to take on the full liabilities and backstop it fully. So this is sort of a peripheral measure, and people are asking now, is it enough to really shore up the credibility of an institution?
Well, look at how Jamie Dimon was treated back in the day after buying Bear, Tom.
Yeah.
These banks, even if they could, I don't think they would.
No. I think for us to pontificate about this is different. Should we talk to someone with some experience?
Please.
At a desk at New York University long ago and far away, maybe in the financial crisis of 1998, was one of the street's best. Allison Williams was iconic at Morgan Stanley. She is now at Bloomberg Intelligence and has been foundational, I should say, in Bloomberg Intelligence's global financial coverage. She joins us this morning. Allison, you and I could have a 3-hour conversation on this. I'm going to cut to the chase. This bank is very tiny. It was rolled up by Merrill Lynch, rolled up by Bank of America. There were 47 transactions. They got rid of this dog. There it is. Why are they saving it this morning?
So I think a couple of things. The first is that obviously this is an interesting transaction, as you pointed out. That they didn't buy the bank, but we have 6 big banks putting a show of faith into this smaller bank. And I think it does a couple of things. I think, let's say that someone had purchased this bank. Then the next question is, okay, now the next one, what's going to happen with that one? And then the next one and the next one. And so I think this is a way for the banks, and I'm not sure if we've confirmed there's the government's involved, but all Bloomberg reporting has told us that, right? So the government and the banks are saying that the big banks are well enough that they can give this put these deposits in the smaller bank. And I think it's a way for all involved to say that, we are going to stem issues.
Allison, I'm sorry to interrupt, but I have too much respect for your work. Are these deposits?
Oh, are they deposits? Yes, they are deposits. They're deposits, but I think that it is the big banks literally putting deposits in the smaller banks.
So people watching this show this morning that have individual accounts at J.P. Morgan may have deposit accounts at First Republic?
Well, I guess you could follow the string of the money, but I think that at the end of the day, taking a step back, at the end of the day, the government basically insured the deposits of 2 smaller banks that failed last week. There's a broader question, does that mean that all deposits are insured? I think in this particular case, if the government's involved in asking these big banks to do this, we can assume that this smaller amount is insured. But I think it's also showing you that the government does not have appetite to insure the entire base of the banks, but that they will continue to do these smaller transactions to show that they will do what's necessary.
When Janet Yellen says things like Americans can feel confident that their deposits will be there when they need them, when the Treasury Secretary uses that language, Alison, it's almost like, it feels like at least, a bit of a confidence trick, because they're not addressing the FDIC limit. It's almost implied after Sunday that that's gone away. Do you sense that the American consumer is behaving in that fashion, in a belief that that is the case?
Well, it doesn't seem so. I think that's why you saw First Republic, the stock turn back, right? So we had the announcement that the banks are coming in and helping. Then we had the announcement about what was going on behind the scenes, and the stock turned the wrong way because investors obviously have been pulling funds from that bank.
I'd love to hear a response of what you think of what authorities did. I was reading through the article that John was flagging earlier in the Financial Times of some of the criticism, and this one member of Peterson Institute, a think tank in Washington, said, from a financial stability perspective, they really killed a fly with a sledgehammer. Do you agree?
I suppose that could be one way of putting it. I think that at the end of the day, they are trying to, like many actions, right? They're trying to send the signal that they'll do what they need to. So it's not necessarily about, the small amount of $30 billion by these big banks. It's about the fact that these big banks did coordinate, they did listen to the government, and that they will come in and stabilize things. As we know with every prior crisis, right, they keep doing things until we finally get something that investors say, okay, they do mean business and they will do what they need to do.
John, what Ms. Williams brings up here is important, and that we're learning along the way, I guess from 1998 or from 2008. And to your point on the Europeans' scathing comments on America, I'm sorry, we're trying to have a pain-free banking crisis. That's what this is about.
There's always a trade-off,
2 weeks in.
There's always a trade-off. You've talked about it, Tom, throughout the whole week. Over the weekend, they failed to find a buyer for the institution. And ultimately, that was the big problem. And they got to late in the evening, and we've seen a lot of people reporting on this colour.
Yeah.
And they had nothing left to do but come out with this.
What's interesting to me is initially people were saying they acted really quickly because they learned their lesson from previous crises, and they wanted to come in and prevent the crisis in confidence before it became a crisis in banking. And now people are saying maybe they overreacted in the same breath that they're concerned that it hasn't been enough to stave off the contagion. Basically, people aren't sure of how deep this goes, and I think that their response raised more questions than it did answers about the duration of this.
That's an issue. I still think they moved really quickly. I still think authorities have learned from the past, which is why we've seen these kind of reactions. And I still believe, and I know it's difficult to judge the counterfactual, but if these events developed pre-07, we'd have a very, very different crisis on our hands this morning.
And so now people are talking about the moral hazard and people are talking about the fallout, but we're not talking about a quickly spreading wildfire concern of confidence in the same kind of way. So at what point was it a commensurate response versus something that was an overreaction? It's hard to say.
Just want to thank Alison Williams just quickly. Alison, thank you for joining us on the phone there to work through some of these issues. Rick Reeder of BlackRock said to me a long, long time ago that Wall Street is always focused on the shark closest to the boat. It's always the case. You become obsessed with it. Shark close to the boat, that's where the attention is. This morning, China cutting the reserve requirement ratio to boost the economy. Tom, what is going on over in the world's second largest economy? We've just had this massive reopening. You'd think the demand would be there, and now we're talking about the supply of credit
and buried
in China.
Buried in the news was that Goldman Sachs, correct me if I'm wrong, went to a 6 handle on GDP growth. So you go, okay, wait a minute, 6% growth, and we're loosening. And again, I think these are the knock-on effects, the global ramifications. Credit Suisse just broke down elegantly to 1.94. That has a knock-on effect to the banks trying to save First Republic Bank.
Credit Suisse down about 4%, Lisa. First Republic right now is negative 4% also, but that was so much worse earlier for First Republic.
I think people were worried that they're not. It's going to all change. My goodness, every second feels like a different story that you could play.
Equity futures down about 0.1% from New York. This is Bloomberg.
governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
Bramo's killing me in the break.
She's
so
like, it's
philosophical.
Friday. She's got the Friday
she's
thing
laughing.
going.
She can't keep it together.
Sorry, I'm pulling it together.
I'll share the question
Very
with
serious.
you. Went a little something like this. When is QT? Not QT. We'll talk about that in a moment.
Shakespeare.
Good morning. Equity futures. This is what we do in the commercial break. Just Bramo.
Very cool.
Big thoughts.
Friday, Bramo.
Equities down about a tenth on the S&P. Up on the week. Up big time on the week on the Nasdaq 100. Up every single day. Monday, Tuesday, Wednesday, Thursday. It's like nothing else has been going on. Looking at the Nasdaq, up 6% week to date through the close on Thursday.
I never would have guessed S&P 4000 on this Friday.
That's
morning.
crazy, right?
Ever.
Look at the bond market, 2s, 10s, 30s. 2 years been all over the place. This morning, bit of calm. We're down 4 basis points, 411.74 on a 2-year, on a 10-year, 352.80. Yields in about 5 basis points there. In the FX market, Christine Lagarde really setting things up for the Fed next week. I thought President Lagarde, did a decent job, all things considered. What else were they going to do? There was clearly a tense governing council meeting over the previous 2 days. Clearly some officials, and Lagarde said it herself, did not want to hike.
Yeah.
But ultimately, what closed the deal was this fear of the signal it would send if they didn't after pre-committing to 50 over the last month.
And also dealing with bankers that don't want to make tough decisions, so you do what you have to do. I thought what was interesting there, John, is they still model out some form of disinflation out 1 year or 2 year. And that's an overarching theme here, back to the equity market, that disinflation is in place, according to the optimists.
We're talking about forecasting to 24 and beyond.
25. Yeah. Where's Credit Suisse in 2025?
I paid this much attention to ECB forecasts out yesterday. ECB forecasts right now, forecast from any central bank, any bank.
How about the dots?
Beyond next week. Well, that's the problem for the Fed, right? They've not just got to put out forecasts for growth, for inflation, for unemployment. They've got to put out forecasts for where they think the policy rate should and will be by year end. I think the beauty for the Fed right now is the previous SEP had the median dot for 23 at 5.1%. They could maybe just leave it there and just say, we've got no idea where this is going, and compare that to where the conversation was the week prior, which was that's probably going to come up to 550 because, they might have to go to 6 because this economy just won't slow down, and here we are with banks breaking. Equity futures are just a little bit negative. I want to finish on euro-dollar. I set you up for that. Euro-dollar looks a little something like this, 106.38. Positive a quarter of 1%. Seemingly the ECB following through 50 gives people at least the idea that the Fed might follow through with 25. I know it's not apples to apples, different situation in Europe, perhaps lagging in the effort to contain inflation versus the United States, but still, I think a lot of people see it that way. So that's the euro. Let's get to the banks just briefly. A lot of people tuning in for that. If you are just tuning in, welcome to the program. First Republic down about 3.9%. Big move higher yesterday. Trying to instill some confidence in this bank. In America, 11 firms deposited $30 billion to try and backstop some of the confidence, reinstill, inspire some confidence in this institution. That's at 33 in the pre-market. Credit Suisse has been the other name to look at. It's down about 4.7%. We reported that UBS and Credit Suisse aren't interested in a tie-up. I would perhaps reframe that UBS is perhaps not interested in a tie-up. because, Tom, UBS has got its own strategy on where it wants to be and where it wants to go.
And our guests that are living in Zurich and have been former Credit Suisse employees make clear they agree with that. I had some technical veracity to Credit Suisse early in the week, and then it's what we call soup, where the technicals just simply don't help. So this morning, maybe I'm shaping up with some technical analysis of Credit Suisse. We'll have to see here at 1.93. Right now, perfectly timed is George Concalves. He's head of U.S. macro strategy at MUFG, encyclopedic on what's called full faith in credit, which is away from the banking distress of the moment. George, are your spreads, are your ratios, are your dynamics within sovereign debt, is it of any use or value right now, or is it just simply distorted by this set of financial crises?
Good morning, TGIF, and happy St. Paddy's Day, everyone. I think at this point, we have to take everything with a grain of salt. The sort of volatility that we had this past week is unprecedented. I mean, I've been doing this for over 25 years, and this surpasses COVID/2008 shocks that we saw, and the rates market is really just trying to get its footing. And really just reacting to overall positions and stuff like that. So I think let's get through the end of today and see how the weekend goes and Monday before we pass judgment.
When you see all the news flow, including the great work from our banking team, do you suggest that the flow statistics we're hearing, the deposit movements, are really not the true picture of the money moving into money market funds? Is it a much bigger statistic?
Look, this has been a phenomenon, and obviously this past week has most likely accelerated this, but we've been seeing money fund flows all throughout the start of the Fed hiking cycle. This is what happens when you raise rates and you have a vehicle that can actually pass it through, and the banks weren't passing it through, and that's really the challenge. And so I think rates heading higher or staying where they are even would still continue with this phenomenon of migration out of banks into the money markets.
I think it's FARBAST index on the Bloomberg.
Yeah.
It's Lisa's favorite ticker.
4:30 p.m. every Thursday.
It's the balance sheet for the Federal Reserve.
Farbast.
So, George, let's talk about Farbast index, the Fed's balance sheet. George, is growing. Sure. It's undoing QT. Can you tell us what's going on there?
Let's hope this is not QE 2.0 like we had in 2019 when the Fed balance sheet started to expand and they were not doing QE. There was really targeted easing and providing liquidity and really lending, not necessarily doing QE. I mean, this is the artifact of the extra liquidity that had to get put in place to help these these entities that are now in the hands of the FDIC. And there's some usage of the new program as well, the TBFB, which I have a hard time sometimes saying, and end up saying FBB, So all I know is that there is there's been a big use. I mean, the discount windows has seen that. We're at record levels, but this is all new. I think that we have to get through this weekend. We have to see what happens if there's really no announcements of an additional kind of bank failures or concerns around the banks there. Then I think hopefully cooler heads prevail into next week, into really the end of the month and the quarter, and hopefully less usage of this program.
But there's a larger question here, George. I mean, yes, I do look at Farbast index every single Thursday at 4:30 p.m. and I see how the quantitative tightening is working out, and it has been working out. They've slowly ticked away about $600 billion of their balance sheet, and then boom, $300 billion added overnight when you take a look at the past week. I mean, it really undoes a lot of what we've seen. Now, you could make an argument that these are earmarked assets, that these have very specific purposes, that they don't sort of percolate into the larger economy. But does this signal it's the end of quantitative tightening? We're done on that front, and that even if the Federal Reserve continues to raise rates, the balance sheet's going to remain at this level and supporting the market?
Look, that's a great point, great question. We just don't know. The thing is, I mean, look, at the end of the day, you need to provide this excess liquidity, and then this is the old classic, Baggett's theory. Lend at punitive rates. You can argue maybe this is not punitive rates, but it's providing liquidity. That's the job of the Fed when we get to these sort of crisis periods or mini crisis periods. The balance sheet has been tightening. What we don't realize, the reverse repo program was QT on demand. They took trillions of dollars out over the course of the last 18 months, and they're sitting at the money markets. So as long as we have the RRP as large as it is still locking up liquidity.
George, The response in markets to yesterday's move by the ECB was to rally because of confidence. 50 basis point rate hike, yay. I actually can't explain it, but that's a narrative some people are putting out there. Do you think that the response will be the same in risk assets in the U.S. if the Federal Reserve raises by 25 basis points, says similarly hawkish things as the ECB, that there just isn't the end of the rate hiking cycle, and says that they're going to continue to unwind their balance sheet at the same pace?
Probably not so. I mean, I think the Fed has to also display some sort of confidence here. But again, we had the ECB hike. The data still warrants the Fed to hike. There's the usage of the facility relatively low. I mean, it's been used for the right reasons. And as long as we don't have any bank failures, over the course of the weekend, and things are hanging in here. At the end of the day, the Fed wants financial stability. If they get it over the course of the next 3 days, they could hike, but this is going to be a very close call. I'm still, calling for a pause because look at the volatility that we have just entering in today. The rates market tried to sell off yesterday. It's rallying back down again. There's still concerns around the banks. So it really comes down to stability into Wednesday. Close call in my book.
So, George, why did the ECB hike?
I think it's not, the epicenter is not there per se. It's obviously been priced into the market. I think if it's priced in and then being much further behind on the inflation fight, they might be closer. I mean, they're now kind of more data dependent from here as well. So everything is data dependent. We're closer to the end, if not at the end of the hiking cycle. We just don't know. We'll find out in the next 2 months, 3 months, and we'll see what the dots give us next week. I'm also viewing pretty much a no change. Gives you flexibility for the June dots. If things blow over here and we look at May into June and things are a little more stable, the Fed can continue to hike. But this is that would be very unusual. They rarely stop and go.
Michael Hartnett of Bank of America, fantastic strategist out of London, makes it very simple sometimes, George. He said this: bank emergency borrowing equals tighter lending standards equals small business credit crunch equals higher unemployment. George, is that the sequence of things that will just take care of business for the Fed?
I think so. I mean, I've been on the show a number of times, and you've always asked me, why do you have a higher rate profile than a lower rate profile in the second half of the year into 2024? Ultimately, this tightening was going to cause something to break, and it's coming through. It's going to hit the economy, much more at the local level. And I think that's how it works. And now that it's pulling forward the recession, most likely. I mean, I still have that as our base case. And eventually the Fed will have to ease. But at this point, I think that they're at that kind of inflection point where it's going to be important to see. And yes, banks are going to become more risk averse from here on out.
Hey, George, wonderful to catch up. George Concavas there of MUFG. You've heard that from George just there from Bank of America. Michael Hartnett spoke about Wells Fargo, indicating the same thing. Morgan Stanley yesterday. I think Jan Hatzius, Goldman and the team doing the same thing. Ferroli, JP Morgan, all thinking about that sequence, that process of just tighter lending standards leading to softer growth. There is some pushback against this theory. Neil Dutta, Renaissance Macro yesterday. Jay Pawlowski, TPW, still constructive. They look at nominal growth, Tom. You make this point all the time. We live in a high nominal GDP world still in America. For them, this Fed's going to perhaps back off and growth's going to be okay. That's the bullish theory.
It's a bullish theory, and maybe it's the gradually to suddenly, where nominal GDP, as Mr. Dutta said, I believe yesterday, 5 to 6%. That gets it done for a lot of non-financial America in terms of continuing growth, where gradually they run into higher rates, and then suddenly it changes. It's out there.
Well, here,
somewhere.
The issue that I have is, hasn't this been going on all along? Is this going to really be suddenly a tighter, even tighter lending conditions? Because why? Deposit risk?
What song was that?
On a Friday, who knows? I would suggest we're slightly more accommodative in the last 18 hours.
Do you want to take us to break?
No.
With a bit of singing? No?
I can. Princeton beat Arizona, so my bracket is just ruined.
I didn't even do a bracket this year.
I said I was going to do it, and then I failed.
No, I didn't do it.
Princeton beat Arizona.
Is that just shocking?
Yeah, that's the posh team won.
Oh, right. And usually the posh team aren't good at sport.
Yeah, that's usually the way it
usually
works.
the way. Because the real athletes...
They're good at banking math.
Ah, nice. But not basketball. But apparently they are. Okay, Bruce Kasman, JP Morgan, joins us next. That was good. Which is your sports segment on Bloomberg Surveillance this morning.
Formula One in the next hour.
American sports with us, just deadly. Deadly.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. North Korea launched the most powerful ballistic missile in its arsenal just before a rare summit between Japan and South Korea, with leader Kim Jong-un saying he wanted to, quote, strike fear into his enemies. Now, Kim was on hand with his preteen daughter to watch the Thursday launch of the intercontinental ballistic missile. North Korea has fired off about a dozen missiles in a month. Baidu surged more than 14% today after brokerages, including Citigroup, tested the company's just unveiled chatbot service and granted it their preliminary approval. Baidu's leap reversed a 6.4% loss on Thursday after founder Robin Li debuted the new artificial intelligence technology over recorded video. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
From the world of politics to the world of business, Balance of Power is now live from Bloomberg's Washington headquarters at a new time. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players. Balance of Power, now weekdays at 5 p.m. Eastern, only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg.
Inflation is projected to remain too high for too long. Therefore, the Governing Council today decided to increase the three key ECB interest rates by 50 basis points, in line with our determination to ensure the timely return of inflation to our 2% medium-term target.
The ECB President Christine Lagarde going 50, then what? Who knows? No guidance whatsoever on the then what, and for good reason. Here's the market for you this morning. Just a quick snapshot, a flavour of things for you. Equity futures down about 1/10% on the S&P. Up on the week on the S&P. Up on the week big time on the Nasdaq by about 6%. In the bond market, yields lower, 4 basis points on a 10-year, 353.36. On a 2-year, down about a basis point. Let's call it 4.15 on a 2-year. Euro dollar positive 0.2%, 106.28. Tom, some people believing that Christine Lagarde has laid the foundation for Jay Powell to go 25 next week. If they've gone, maybe they do too. To Josh Concalves' point of MUFG, I think you made the point, Tom, that there is a difference between what Europe's experiencing and what the US is experiencing. Feels like the US is the heart of the storm at the moment for the regional banks. Yes, there's Credit Suisse lingering, but maybe not the same concerns. And also the ECB started later. Inflation's still higher there. there are differences, I get that, but it's the psychological point that they had to address at the ECB that I think the Fed will equally have to address as well, which is the signal you send if you don't hike.
You saw it better than I did yesterday, but I'm going to give her high marks for stability within chaos. And John, let us be clear here. Credit Suisse cannot find a bid this morning. It's fractional to 3 digits, but I'm looking for a bid on Credit Suisse, and it's not gloomy like 2 days ago, but we need to pay attention to that. And I'm sorry, the chart is shaping up to be somewhat elegant.
It's on the problems they entered the year with are still the problems they have now. That's the problem
for
with
everything.
Totally.
We're not clearing markets is to me the heart of the matter. I mean, I would go with that. This is going to be a joy. We're going to find a pause on Friday as you think about this into the weekend, and we ask Global Wall Street to really lean forward. To a true student of all of this. Michael McKee is with us, and he's the only one I know who reads speeches at the Homer Jones Lecture of St. Louis. They have been going on for years, and I'm going to go back to Anna Schwartz, who was definitive on how the Fed was built with Milton Friedman. I had a fractured lunch with her in, I think, her 94th year. And Anna Schwartz wrote years ago for Homer Jones Lecture on the misuse of the discount window. Alan Meltzer would agree with that. Are we seeing a misuse now by the banking industry of the Fed?
I don't think so. I mean, people don't want to go to the discount window. They use the discount window when they're troubled, and it's always had a stigma. And it's interesting that so many people went to the discount window in the last week. Now, it may be because the new financing system was not set up until Monday, so people couldn't access it, and there were a lot of withdrawals going on Thursday and Friday of last week, which this Fed report captures. And also, the discount window takes a wider amount of credit, different kinds of credit than just the new bank lending facility. So it tells you that the banking system was troubled. There were a lot of outflows, and banks felt like they had to go to the window.
John, we don't know what those outflows are on this Friday.
They've probably got a decent idea at the Fed after their experience of the last week, haven't they, Mike?
Well, that's the thing, is they're going to know much better than we are what's going on inside these banks, because they've got examiners at the banks. And yes, there's a question about whether they did a good job or not, but you can bet that starting on Friday, they were parked at the auditor's office at Silicon Valley Bank and looking over the books and figuring out what was going on.
For people who aren't familiar, why is there a stigma associated with using the discount window?
Well, because it's the sort of lender of last resort window, and if you go there, then you're seen as being perhaps a badly managed bank. And so people have not wanted to use it. The Fed has rejiggered it several times trying to get rid of some of that stigma, and it's still there. And it's one of the reasons they created this Fed term lending program on Sunday, is because basically they wanted people to go and borrow from them, and this is one way to get around the stigma.
We're looking right now just to give a sense of the scope of what the use was like. Basically, the use of this discount window surged to a record of $152 billion, $152.9 billion of borrowings. That compares to the other all-time high of $111 billion during the 2008 financial crisis. Does this suggest the scope of a crisis that is bigger than perhaps we have fully understood? Or does this indicate that the Fed is petrified about financial stability concerns amid a rate hiking cycle that they do not see as over?
Well, I'm not sure we know yet, because it's only 1 week's data, and it's been such a crazy week. I talked with somebody at the Fed yesterday who pointed out that banks can borrow even if they don't need it yet, and there may have been some pre-borrowing, in other words, an effort to load up in case they were attacked. They don't know that for sure, but it does show that there was a lot of concern in the banking system. Now, we don't know how many banks borrowed. If you had banks all across the country borrowing, then that might scare the Fed more than if it were just some of the ones that we know about that have been in trouble.
There actually was some indications that First Republic accounted for quite a significant amount of it. So there was some specific idiosyncratic risk within this. They put out a statement on that, I believe, yesterday. I'm curious, though, to draw that distinction between when this is adding liquidity to the financial system versus not, because it seems like that is a confusing point when you see the balance sheet of the Federal Reserve surge leverage by $300 billion.
It is a confusing point, and I've seen a lot of confusion on certain social media overnight here. These are what you call temporary open market operations. While they add to the balance sheet a little bit, they aren't really going to have an effect on interest rates.
It's QE.
It's not
Twitter
QE,
says it's QE.
which is, yeah, well, we know that Twitter's never wrong. But permanent open market operations are QE, where they're continually buying in order to push down interest rates. And I was looking this morning, and you're not seeing any kind of interest rate reaction to this. I mean, we've had a lot of volatility in the 2-year, but overall, the effective Fed funds rate is still where it was, and we're not seeing major moves in the money markets. Another thing to keep in mind, too, is we're still seeing $2 trillion a day in money being, in cash being sent back to the Fed by the money market funds that have way too much of it in order to get securities. So it's not like this is an interest rate moving operation. It does raise the balance sheet, but it's temporary.
If we're having a pain-free crisis with a political overlay and all that, how do you perceive this clearing? I mean, at some point, we have to have Schumpeterian creative destruction, which I believe is French for banks have to go out of business, right?
Yes, and I leave it to Allison Williams and people who are smarter than me to tell us which ones.
That's Bramah.
But
Bramah's in charge of
there is a feeling that we're going to see some mergers and acquisitions, that some of these banks aren't going to be strong enough to survive by themselves. No banker wants to sell his bank, so it may take a little while. And obviously, the whole Credit Suisse thing is a complicated deal because there are only 2 banks in Switzerland, basically, and they don't want to go down to one. And we know that the business plan is troubled for Credit Suisse, so does UBS want them? No, they don't, according to our reporting. So it isn't clear how that's resolved. But once we see some of these banks maybe get bought up by others, it is more complicated these days because there are limits. It used to be Jamie Dimon would just go out and buy a bank and take it home for his kids, but now he can't do that.
I'm not sure that's how it works, but yeah, go on.
Now he can't do that because they're so big.
Sally,
there are regulations against that would have to be waived.
Mike, just to build on that though, even if they could, why would they? The pushback, just the way they were treated after the financial crisis, after doing those things.
That's probably why Mr. Dimon was meeting with Janet Yellen yesterday to say, I don't want to buy a bank, but I know as the biggest bank in the universe, I need to do something here. And so we come up with this plan to get all my friends to put some money into First Republic and maybe staunch the bleeding. What's interesting about First Republic this morning, and maybe you've been listening to, people have been telling you more than me, but it seems like now the problems with their stock in the pre-market are based on earnings. The idea that because they suspended the dividend and you're not going to make as much money, as opposed to the idea that they're going to go out of business. And I wonder how that carries through the day.
Can I channel my inner Senator Warren?
Please
try. This is off the bank rate. This is off the bank
rate.
This is off the bank rate website this morning. A jumbo mortgage of 7.02%. on a Hawaii $1.5 million home, you take out a $1 million jumbo. That's really what this bank does. That's their. I think that's
what they say. That's why the people were concerned about First Republic, is because they are basically a bank to high net worth individuals, and those people were not insured, and so had reason to maybe pull their cash out.
Senator Warren, I'm lost. Thank you.
That was the impression. Thanks for that. We're all waiting for that, Mike. This was brilliant. Mike McKee, thank you. Equity futures slightly negative.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight, with replays all weekend on Bloomberg Television and Radio.
Chris, can I ask my landlord for a rent cut in the next couple months? Like, is that reasonable?
Well, I guess it depends when you signed your lease, Joe. It sounds like you got kind of one of those pandemic deals that, particularly in New York City, where rents actually fell really sharply in that first year of the pandemic. So we are really seeing the market having turned a corner a little bit over these past few months. Prices have been coming down for 4 straight months now in our national rent index.
Wow.
But you know, if you're still paying that late 2020 level, then you might not necessarily be eligible for a discount at this point.
Good point. All right, I have another question, which is like, so I have 2 kids, but unlike other people, I actually am cool, and I don't want to move to the suburbs. Like,
This episode is just Joe taking like advice on handling his rent.
I just want to point out, I really like my landlord.
You love your landlord?
She's very attentive. We have a very good relationship. So even though I started the episode saying I was anxious, if she is listening to this, I hope she hears that I really enjoy where we live, and I really enjoy our the landlord.
She should factor your consistency into her pricing algorithm.
We've never been. Yes, exactly.
Excellent.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
The top names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg.
Certainly need strong bank supervision in all seasons, and I think clearly this episode indicates that there's more to do on that front.
The banking system, as I would say, appears fundamentally resilient.
I think the contagion's limited, but the same impulse could cause more effects at other banks.
Credit Suisse is a much more complicated, entangled financial institution. I think that's where kind of there's more fear.
Ultimately, I would say Credit Suisse is not out of the woods yet.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Trying to get you to the weekend, live from New York City this morning. Good morning, good morning. I'm going to say that every hour for you. Equity futures on the S&P down about 1/10% on the S&P 500. First Republic in the pre-market down about 10%. 11 American banks coming together to deposit $30 billion at that institution. Tom, we are trying to inspire confidence. Have we done enough in the last week?
That's a measurement here, and we're going to have to see over time. But what this really comes down to is the mysteries of what are the flows, what is the stability at this very small bank. What I tried to emphasize at the beginning of the last hour, John, is in the blur of it all, we go JP Morgan, First Republic Bank, and the teensweens level of this bank. This is a tiny bank. It used to be part of Merrill Lynch and Bank of America. It was thrown out the door to do high net worth individuals. And you've got 30 banks wasting their time on it this morning.
Every bank is different, Tom. Every bank is different. SVB, we were told it was for tech bros, right? Then the other bank over the weekend, that was crypto. Then Credit Suisse, they've had problems for years. And now First Republic, we're saying the same thing. Very, very unique institution. I get it. But Lisa, at some point, it all adds up, doesn't it?
Especially because regional banks tend to have greater exposure to commercial real estate as well as consumer loans and some of the other areas that bigger banks have gotten out of a bit more as a proportion of their assets. These are the more vulnerable places as rates rise more quickly, and they haven't necessarily had to have the same regulatory protections as the larger banks. So the question isn't just, are these banks going to go under? it's also how much does this constrict lending at many of the basic places where lending is distributed throughout this economy?
I'll go with that, but I think this bank is as narrow as the Silicon Valley. What you call them, bros? Is that,
No, it's not my. That's what people would say about SVB.
Yeah.
They were saying it wasn't,
Okay,
and
so
of course
they're-
it was way more than that.
They're techie VC.
But there was an excuse for every single financial institution over the last week.
This is important. Here's the strategic plan, folks, for First Republic Bank. All the rich people are moving to Wyoming. Set up a branch. That's it. That's their business plan. I mean, and where's the next Wyoming? Is it Miami? I don't know. Set
Okay,
up a
but
branch.
then if you take that a little bit further, so then why do we care, right? That's sort of the question.
Thank you. Well
but then
said.
you've got Signature Bank, which was a crypto bank that was shut down. It's one of the dominant players for commercial real estate in New York. When you have banks that have concentrated
Well-
exposure to specific industries, do you start to get mini systemic risks that regulators get concerned
In the
about?
blur of this, and I know, John, we've got to get to CSFB, but the bottom line here is Lisa mentions the unspoken. The unspoken is commercial real estate. It always is.
Yeah, but I
It
don't want to
always
make
is.
this conversation just about high net worth individuals in the United States of America. This was also businesses trying to make payroll. There were also businesses
That
over
was
the
it
weekend,
with your bro
you
a
know,
week ago.
asking the question, and way more than that. That's what's happening across this whole country over the
100%.
last week. Why do you think they are coming in to do this? It's not just about First Republic. It's not just about that institution. It's about the whole system. It's about the whole system. That's why Janet Yellen this week is in front of the Senate saying that your deposits will be okay. And the pushback is, okay, but up to what? Up to what? Is it the insured limit, or are we now implying it's everything?
It is 60,000 foot level. We're having the same argument they had with Andrew Jackson and Beebe in 18. I can't remember the date, the second bank of the United States. This is big banks, small banks, and their institutions, including the big banks, are trying to figure out how to do this in a new political way.
I think there are a bunch of economists out there at the moment, Tom, also looking at it two ways. This doesn't have to be a disaster. That's
Yes.
one thing. Let's park that. Let's focus on this. This is the base case for most people right now. Michael Hart at Bank of America put out the note this morning. And for those of you just tuning in, welcome to the program, and I'll read it out for you. Bank emergency borrowing is going to lead to tighter lending conditions, which will lead to a small business credit crunch, which will lead to higher unemployment. That's the sequence for a lot of economists out there. Even if you don't believe that the worst case will materialize, for a lot of people out there this morning, over the last week, Lisa, this is now the base case.
And in the meantime, you have every small business looking to make sure that they have cash integrity and they can withdraw their cash at any time, which is a reason why you're seeing a shift into some of the biggest banks. But at this point, we are looking at smaller businesses that are facing more uncertainty, substantially more uncertainty than a week ago, and that's going to matter.
We want to inspire some confidence, and let's see if we can in these
Should
institutions.
we go to Zurich to do that?
You want to look at Credit Suisse briefly?
And right
Down
now, it's
6%.
all of a sudden, seconds ago, it became technically elegant, and the elegance is south.
A break of 190.
I don't want to get inflammatory, but this chart is not the Credit Suisse chart of yesterday.
And not much reporting overnight. We've reported that Credit Suisse and UBS don't want to dance. I think it's UBS that doesn't fancy that dance, to be honest with you.
Yeah.
Based on that reporting, they don't want to tie up. They've got their own strategy. We'll touch on this later. 190 on Credit Suisse. I want to get to Dan Skelly of Morgan Stanley.
Excuse me.
He joins us right now. Dan, wonderful to catch up with you, sir. Dan, what a week. What stands out for you, Dan? It's been so quiet.
Yeah, John, it's been a really boring time out there, huh? Happy Friday to you and to your peers there. So look, what I would say is there's been a couple of surprises so far. I mean, I think when you look at the U.S. equity market, we haven't really sold off that aggressively. We've seen growth and NASDAQ become a defensive play again, and maybe some of that's warranted on the strong balance sheets. But John, the story remains the same that we've been talking about in recent weeks and recent months. The effects of the banking slowdown that Lisa alluded to before have been yet to be seen. And so we just don't think you're getting paid enough in the risk premiums of the equity market for this type of environment.
Dan, is the Fed super restrictive? If you take the synthesis of Ellen Zentner's research and many others at Morgan Stanley, can equity participants say that they're working now in a restrictive central bank environment?
Tom, you can, and the reason for which is if you back out and think about historical precedent, historical context, I think since 1982, there have been 12 dovish turns, and that's an inflection where in 1 month, the Fed went from hiking to cutting. And when you look at the backdrop in those 12 different instances, inflation was running about 4% below Fed funds rates on average. And today, of course, as you know, we're running about 1.5% above Fed funds. So I think it's very difficult to say that we're fully restrictive just yet in terms of monetary policy. That being said, as Mike Wilson has I think, aptly highlighted in the last week or so, you are starting to see the long and variable lags impact now.
Dan, how has your view changed over the past week in terms of your risk aversion? How much more risk averse, how much more inclined to be in cash on the heels of some of the financial system distress?
Lisa, not much. I think you nailed it earlier in terms of the environment. No, this isn't a credit crunch. It's not a financial contagion repeat of 08. And ironically, some of the bigger banks are already reporting inflows of deposits. So the system will hold, right? So we don't see that draconian outcome. So in that regard, we're still sticking to our framework that we've been talking about all along for this year, which was favoring credit over equities, within equities being a little bit more defensively oriented, quality oriented, dividend oriented, and then looking outside the U.S. into some international ideas, which frankly have still trended higher relative.
Dan, Bob Michael earlier on this week was on with John talking about how this is just the tip of the iceberg in terms of risk aversion, and there are many more shoes to drop. And I'm curious where you think we are in terms of people getting wary of the growth prospects and the read-through to equity valuations.
Yeah, so Lisa, we have a pretty tight framework in terms of what we need to see to get more aggressive, and we're just not there yet. When I go down the checklist, we need to see risk premiums at least 100 to maybe 200 basis points higher. Yes, you've seen some spiking in recent weeks, but we're not there yet. We would think 300, 350 on equity risk premium. We need to see earnings expectations lowered to sub 215. We need to see a higher VIX. Frankly, low 20s on the VIX isn't there yet. You probably want to get 35, 40 to see more capitulatory nature on equity fear factors. And then lastly, you need to see not just an incremental slowdown in hikes or a pause, you need to see easier monetary policy. And as you know, Ellen Zentner and team has forecasted early 24 at the earliest for that particular dynamic. So we're just not there yet in terms of seeing the framework adjust.
Dan, let's get to a word that gets thrown around on Wall Street. I want to play defense. Lisa and I were talking about this yesterday, Tom too. Defense last week meant USIG, and that meant a bank that was about to fail. Dan, what on earth is defense in this world?
Yeah, so Jonathan, it's an excellent question. And look, last year was the year of nowhere to hide, in which stocks and bonds declined together. A super anomalous type event that's only occurred in 2% of years since 1926. So listen, our view coming into this year was that correlation in terms of bonds defensiveness would reassert itself. And for the most part, you've seen that, Jonathan, right? There have been days and hours where you've seen everything correlate to one. But on balance, bonds are starting to act like themselves again, give you ballast, give you some diversifying benefit. And that's frankly largely a function of just how far rates had backed up last year in terms of that margin of safety and valuation opportunity. And so, look, we would still say within short duration government and high quality investment grade credit, that's a defensive area of the bond market still. We still prefer that over equities at the moment. That won't last forever, by the way. I think you're coming into a window maybe later this spring, early summer, where we'll be on to our next fiscal and financial crisis situation in terms of debating our own debt ceiling, today. Where we'll probably get a better crack at the equity market later this spring.
Dan, thanks for that. Dan Skelly of Morgan Stanley Wealth Management. Something to look forward to. The pushback that I've had over the last week or so, this idea that you start playing the recovery to the recession we haven't had yet. I hear a lot of that, Lisa. I hear a lot of that.
Yeah, and that's been the theme until it wasn't anymore. And I think that's when people are starting to rethink it, and that is now.
I mean, your question today, John, that's the question of the week. How do you play defense here? And folks, it's so defense, you have to spell defense like the Canadians and the British do. I mean, it's just that simple. That's what everybody's thinking this weekend is how do you play defense on this Friday?
I don't know how you do that. And the pushback is genuine against U.S. investment grade. There were clearly some financial institutions that were rated investment grade, which shouldn't have been, based on their performance and what's happened to them over the last week. Credit Suisse right now is negative almost 8-9%. 185 Swiss. So that name's breaking down still.
The chart is textbook as of 22 minutes ago.
In the next hour, Anastasia Amoroso of iCapital.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Turkey is nearing ratification of Finland's accession into NATO. The move brings the military alliance a step closer to welcoming its 31st member as the effects of Russia's invasion of Ukraine spread across the European security landscape. President Erdogan is meeting Finland's head of state later today. Chinese leader Xi Jinping will travel to Russia next week. It's his first trip to Russia since it invaded Ukraine. During the trip, Xi is expected to discuss China's recently released 12-point blueprint for ending the war in Ukraine, a document dismissed by most Western governments. Xi and Ukrainian leader Volodymyr Zelensky also plan to speak by video link soon. Slovakia says it will send 13 Soviet-era fighter jets to Ukraine to boost its defense against Russian forces. The jets are in different states of readiness. All have been grounded since August after a maintenance agreement with Russia was terminated. The announcement comes a day after Poland said it will send 4 Soviet-era fighter jets to Ukraine. And there may be a new COVID-19 source linked to China, raccoon dogs. A scientist studying the pandemic in the country says new research linking the animals in a Wuhan wet market to the virus provides, quote, important incremental evidence that the COVID originated in wildlife. Now, samples collected in January 2020 at the Wuhan market, where many of the early cases emerged, found genetic evidence with the virus with large amounts of raccoon dog DNA. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Studios in New York and San Francisco. Our new hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
There will be a careful look at what happened in the bank and what initiated this problem. I know that the FDIC looked for buyers, and a merger or acquisition is certainly something that they were open to as a way to resolve the institution.
Janet Yellen, a timely conversation on Capitol Hill. The U.S. Treasury Secretary, the New York Times reporting this morning that the Federal Reserve pushed back against including a line on Sunday evening about regulatory shortfalls Lisa. Chairman Powell once again in the spotlight.
The only reason that he mentioned regulatory reasoning at all in the statement was to say that it was good, that it helped support the banking system. It was all positive. And this really raises a question, especially in light of the Biden administration pushing back and highlighting regulatory oversights, failures that he argued weren't really supposed to be in the statement.
Yeah, I don't think this conversation's going away anytime soon. Tom, you did an impression of Senator Warren a little bit earlier. I think you're going to hear more from Senator Warren.
You got to.
On the matter,
I mean,
aren't you?
I mean, this is the reality right now. We got 8 ways to go with our guest here, John. I'm going to cut it. I'm going to give you an anecdote, John, and then you guys can pick up the adult conversation with Gerard Cassidy, who's been fabulous with this week, and particularly interpreting Senator Warren's comments. Gerard, you and I have lived this. You're in Swellesley, Massachusetts, and you need a jumbo on the new place up the coast of Maine in Bar Harbor. Right now, there's an $11 million property up there, and I need a $5 million jumbo. And you go down Washington Street in Wellesley, and you waltz into First Republic Bank, and you get a $5 million jumbo over a cup of coffee. Is that what we're bailing out?
Tom, thank you again for having me on the program. And I would say, I don't think that's exactly what we're bailing out, but yes, they are definitely a jumbo mortgage lender, but they're also a financial advisor, a wealth manager, and that is certainly part of it all. The key, though, is I think it's more the contagion risk that people are worried about, that if you allow any of these very large banks to become insolvent and the depositors at risk, you certainly worry about the contagion risk, which is, of course, what we have worried about in past crises, whether it was the 08-09 crisis or even the 1990 crisis.
Jared, I think a lot of people in America are finding the communication at the moment from authorities to be somewhat confusing. They have implied at some level that all depositors will be made whole. They have implied at some level that regardless of size, most financial institutions in this country would carry that systemic risk exception. And yet there is still nervousness, Gerard. What on earth can authorities do when it comes to tackling those issues?
I think, John, what we're going to see is obviously each day beyond the failures of those two banks last weekend will give us some calm in the markets. People are still jittery, but in my conversations with bank managements this week, what we saw and heard was that, yes, depositors were very anxious on Monday, but as the week went on, things started to calm down a little bit. So I think what we'll see is time will help heal some of these wounds. But you're right about the communication part of it. It has been at times confusing, and I think they need to get a stronger message out there that for the time being, in a period of uncertainty, the Federal Reserve, the FDIC, and Treasury will be there more explicitly than they said on Sunday.
Jared, the public might hear numbers like $153 billion come from the so-called discount window at the Federal Reserve. And Jared, there might be people tuning in this morning, listening, watching this program, finding all of that quite scary. There are these two facilities, Gerard. There is the discount window. It's been around a long, long time. There was a new facility introduced on Sunday evening, BTFP, the Bank Term Funding Program. In really simple terms, Gerard, can you explain those big numbers we heard yesterday afternoon?
John, they're incredible numbers, but when you put it on the banking system, and if you just look at total deposits in the banking system, they're around $17-18 trillion. It's hard for any of us to get our arms around a number, $1 trillion. So our system is gigantic. And these numbers that you just referenced on the discount window borrowings that were announced yesterday are very large. But the economy and the system is extremely large. So putting it in that perspective, the numbers I think are more manageable. But just seeing that absolute number, $150+ billion is a big number.
Gerard, this one French policy expert quoted in the Financial Times highlighted the sort of insignificance, relatively speaking, in terms of the scope of some of these banks that are being rescued by authorities, saying this is the U.S. version of small Venetian banks. You are always systemic for somebody. Do you think that that criticism is valid?
I think to some extent it is. I mean, we still have, as you know, Lisa, over 4,600 banks in the United States. And unfortunately, if 50 million bank, if there's any banks that small were to go insolvent, it wouldn't cause the repercussions that a $200 billion bank did. So even though the $200 billion bank is smaller relative to JP Morgan or Bank America, as you all know, this was the second largest bank failure in U.S. history. It's a big bank, even though relative to our big guys, it's not. So they certainly need to put in further controls and procedures. More liquidity might be required, more capital might be required, but the industry is definitely going to see more regulation as a result of what we just came through.
Is there a bigger problem, Gerard, that people are kind of hinting at but not addressing directly, which is that the disproportionate amount of commercial real estate, as Tom has mentioned many times, of individual loans, of sort of the riskier assets that bigger banks have gotten out of, that concentration has regulators and authorities very concerned about smaller and regional banks, the potential contagion and the consequences?
Lisa, we're always worried about commercial real estate. If you go back in time, before even Tom and I were doing this in the 1800s, commercial real estate's always been a problem for banks during a crisis, and it has to be managed effectively. And to do that, you have to your point, you need to keep the concentration risks in a manageable state. You cannot have a bank that has 75% of their assets in commercial real estate loans. So commercial real estate, it's going to potentially be challenging in the urban markets for downtown Class B and C space. But overall, most commercial real estate is underwritten very conservatively. And should there be some higher delinquencies and charge-offs, I think the system will handle it effectively with the levels of capital in the system today.
Gerard, next steps, options. What do you think they are?
John, really good question. And I would tell you, we anticipate that more of the smaller regionals will be required to carry more liquidity. You might be familiar with something called the LCR, the liquidity coverage ratio, where the banks have to hold up to 30 days of money that they would handle or run on the bank. These are our giant GSIB banks, as they're referred to, like a JP Morgan and Bank America. I see more banks being required to do that. You heard a lot about this AOCI, accumulated other comprehensive income. That's where the unrealized gains and losses go for securities. For the biggest banks, they deduct that through regulatory capital. We expect the smaller banks to be required to do that as well. Third, we also expect that the industry will have to pay higher fees to the FDIC to build up the insurance fund, especially if they raise the limit on insurance on the deposits to $500,000. That will be costly to the industry as well.
What is it about a crisis and new acronyms, Tom? Always.
You're
Always,
right,
just like a long list, right?
Yeah.
Jared did a great job of explaining it. Jared, thank you, sir. Jared Cassidy there of RBC Capital Markets.
This goes to the semantics of the moment, and I take immense issue with this word deposit as it's used this morning, as it's been used the last 24 hours. I may be right, I may be wrong, but we need to learn more now away from the semantics. We need clear language from people, including the management of First Republic Bank. I mean, have we heard from them?
Not much.
Not much?
Not much. Sunday evening, they talked about how much liquidity they had.
Yeah, well,
not much since then. Credit Suisse, Tom, down almost 9%. 185.
It's
185 in Swiss trading.
John, it's the way it's down. We don't need a technical analyst lesson right now, but all you need to know, folks, is all of the trends here are challenging beginning about an hour ago. And John, I would suggest it rebounds over into German 2-year and U.S. 2-year as well. I'm not linking the two together, but boy, they're certainly happening at the same time.
There's a little bit of risk aversion developing just over the last 10 minutes. Not in a major way compared to what we've seen so far this week, but certainly there for all to see. German 2-year down 6 or 7 basis points, 254. 340, close to that level about a week ago. The 2-year was through 5% a week or so ago. Right now, 4.09%, yields in 6 basis points at the front end of the curve. Are you singing again?
I am.
Is that because you're about to go on vacation?
Song. It's
you're about to take a week
Linda
off?
Ronstadt, James Ingram.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Looking to close out the week with equity futures down about 1/3% on the S&P 500. A long way to go before we get you to the weekend. Before we get there, here's a snapshot of things for you. The Nasdaq on the week up every single day, Monday, Tuesday, Wednesday, Thursday. Nasdaq 100 so far week to date. Before today's action, up around about 6%. Monster move. Want to look at First Republic? I know Lisa wants to do that too. It's down about 12%. Tom, you mentioned, have we heard from the leadership there? Mike McKee did mention it a bit earlier about the suspension of the dividend. They did put out a statement last night, so I'll read some of that for you. Insured deposits from close of business on March 8th to close of business on March 15th have remained stable. Daily deposit outflows have slowed considerably. I think the key line there, though, is insured deposits. A fraction maybe of the uninsured deposits that exist at this lender. So we'd like some clarity on that too. The bank is focused on reducing its borrowings and evaluating the composition and size of its balance sheet going forward, all of that. Consistent with this focus and during this period of recovery, Lisa, the bank and the board of directors has determined to suspend its common stock dividend. So that really is the latest overnight, but just kind of not much else at all.
And just the support that we heard about from the other banks giving less clarity as to what the longer term plan is, because does it just forestall some larger kind of partnership, acquisition?
11 banks, 30 billion in deposits, trying to shore up confidence in the institution. And I would go one step further, not just the institution. I think that's the big players really turning around and saying, we think the whole system is going to be okay.
Right. And sort of the question is then, why such a big response? And then over to you, Jerome Powell. Do you basically take the same tool that Christine Lagarde did to instill a sense that things are as normal? Let's take a look at First Republic, which shares are lower on the day. And I do think it's interesting to talk about what we've heard overnight and with respect to the suspension in the dividend. But we also are concerned about profitability. And John mentioned this earlier, this concern that they're borrowing at market rates that are significantly higher than they were a year ago, while their assets are paying yields that were perhaps what they would have earned a year or two ago. This mismatch creating a really negative backdrop for them on just simply profitability. Landscape. PacWest falling in sympathy, one of the other regional banks that has been hit over the past couple of days, 5.5% decline. And, you know, this is what we've been talking about. The story is all banks. And what was the expression again? That you just look at the shark that's biting at your boat?
Rick Reed of BlackRock. It's always the shark closest to the boat.
Right. So, but there are other issues, and FedEx really highlights them. Those shares are higher by more than 11% after reporting earnings yesterday. The good news, their margins were better than expected. The bad news, it's because, at least for the economy, it's because they're cutting costs. Their revenues are coming down because their shipping isn't as robust. And so in response, they're grounding planes, they're causing, perhaps a bit of a reduction in certain routes. But this really highlights the economic question that we're all ignoring because it doesn't matter because banks.
Well, I'm with you, but I think that's what the economists are picking up on this morning, whether it's Alan Zettner at Morgan Stanley, Wells Fargo, JP Morgan, Goldman Sachs, and moments ago, Michael Hart at BofA. They are focused on the economic consequences of this, away from the drama, whether you think that will or won't materialize, the base case for a lot of people after the events of the last week is that this will lead to tighter lending standards, which will lead to softer growth. That seems to be the base case for a lot of people after the developments of the past week.
Or the developments of the past quarters as we move from ultra-accommodative to restriction. I'm going to do a little history here because it is most important, without question, our most important guest of the day across America. He is Thomas Honig. To say he's former FDIC vice chairman doesn't describe his leadership of the Jackson Hole meetings we attend. And also, Thomas Honig is a voice of agrarian America. He's a former president of the Kansas City Fed. Tom, wonderful to have you with us today. I want to go back to the sweat right now in the advent of your Fed, which was when United Copper blew up in 1907, and J.P. Morgan sat in a study of a house built by Phelps Dodge money and tried to bail out the financial system. That is the age-old distrust of agrarian America with the fancy people in New York. Is the history repeating itself now with the fancy people in Silicon Valley, and for that matter, the fancy people in Zurich, Switzerland?
Well, that's a bit of a stretch. I would say that what's really happening is the classic night that follows day, because we had a lot of very smart and knowledgeable people who pursued a policy over the last decade or more of a very accommodative, highly accommodative monetary policy with very low interest rates for an extended period of time. And when you do that, if you think back over every crisis, when you do that for a long period of time and inflation of assets and prices rise, you end up having to tighten policy. And that means all these asset values take downward pressure. And that's what we're seeing today. That's what we saw back then.
Right.
And that's what we saw in the 80s. And that's what we saw in the 2008 period.
Is this because of the financialization of America, and that some of these troubled banks are sort of kind of like banks where they're catering to the elite, to the haves, to the have-nots, creating immense distrust politically in Washington, creating immense distrust away from where the elite live?
Well, what they're doing, I think, is when you have this kind of speculative, I mean, this kind of policy invites speculation. So no, it's not just the elites. It's those who are saying, hey, I'm going to take advantage of this, whether you're in the Midwest or in the agrarian part of the nation or you're on the East Coast, you take advantage of this. And then when the problem comes, and here's where I think the resentment comes, you bail out banks, you bail out some banks, and that's what we have with too big to fail from the last time through, and it still continues today. And those who are in the smaller communities who are not bailed out become or lose their job as a result of having to tighten policy so much, they become very resentful and blame it to some extent rightfully on the elites who supposedly know all this. I'm often asked, Tom, these are really smart people. You should just let them, figure this out for you. And I say, well, they're that smart. Why are we in this mess? So I think there needs to be a lot of humility in the policymaking business because it can often go south when you get too cocky, too confident,
Thomas,
too sure of yourself.
Let's talk about the moment that we have at hand, because you have incredible expertise, both as a former head of the Kansas City Federal Reserve as well as the head of the FDIC. And I'm curious about whether your suspicion is there is a more significant risk that authorities are trying to stave off by some of the actions overnight. In other words, what do you make of the criticism that they took a bazooka to basically an itch?
Well, I would like to be able to say that too, that it wasn't as systemic, but there was, with this event, a great uncertainty raised about banks, especially regional banks. And so if I were sitting at that table, as much as I would not want it to, but in a crisis, you do what you have to do. And I would have gone along with that. I think yes, but they are trying to avoid further problems down the road, because when you raise interest rates by a factor of at least 25 in less than a year, the assets, it's not just those government bonds with duration risk that are taking hits. There are other assets, and everyone knows that. That's why you see this uncertainty continue. There's a whole asset on the portfolio of these banks, and those are going to be under pressure with this higher interest rate and with the likely slowing of the economy. And so that's really what they're trying to do. Yes, we're going to, the depositors say, don't run, let's not make this thing worse. And that's what you do in a crisis.
Well,
go ahead. I'm sorry.
No, but I guess that the concern that some people have is, okay, this is a crisis response, but on the flip side, you're creating long-lasting policy without actually creating it. And this goes to ensuring all deposits above $250,000. They're thinking, okay, let's protect all those small businesses so that they can meet payroll. Is there a consequence to having a de facto policy implied by the actions without it being codified or even paid for by some of these banks?
Well, yes. I mean, you have set the expectation today. I mean, everyone's going to be protected. Every depositor is going to be protected. That's if you walk away from that now, you are going to create a heck of a crisis. So yes, that is pretty clear. And what they're trying to do is with these special facilities, lending facilities, say, hey, we'll take your assets at par, especially the so-called government bonds, so that there's liquidity coming into the system. And if there are other problems in other assets, you were talking about commercial real estate earlier, well, at that point, they're going to have to step up and protect these depositors, because that's the expectation. If you don't do it, you're going to have a major problem on your hand. The issue is we never learn from the mistake. I mean, everyone, I've heard this on this program and others, that capital is just, we're well capitalized. Well, if you were well capitalized, you wouldn't have this kind of uncertainty in the system. So you're well capitalized for good times, but can you really take the shocks? Liquidity follows capital, because when people become uncertain about your solvency, they run, and then your liquidity problem forces the issue. So we have to, we're going to have to get through this, and the government's going to intervene. But if we don't learn on the other side of this to watch our monetary policy, our supervision, we need stronger capital. These liquidity recovery ratios, we have to make sure they're actually liquid, because we say bonds are risk-free. Well, they're not duration risk-free. So we better do a better job on the other side of this immediate panic if we're going to avoid them in the future.
Got to get through the storm first, Thomas. This was fantastic. Great to catch up with you, sir. Thank you. Thomas Honig there, the former FDIC Vice Chair. Equity futures down 1/3 of 1%. Want to pick up on Credit Suisse just quickly. Now down 10%. And just about holding on to 180 in Swiss trading, 182, Tom, after tapping the S&B just a couple of nights ago, big time, and that stock is rolling over again to close out a week.
Not yesterday, but 2 days ago, 3 days ago. The phrase is simple. As you look at the asymmetry of the bid and the ask, it's simple. The buyers are on strike. They've walked away. It's like 3-4 days ago.
What about First Republic, Tom? Down 14%. Relative to the moves we've seen over the last week, 14% is not really a major move, is it?
Basically unchanged.
I mean, unchanged, and it's had a bad 20 minutes in that, but I really can't get a good handle in pre-market. We have the advantage in Zurich of active trading with volume, with liquidity, so you can do the fancy math. I can't do that right now in First Republic.
The fact that it's so choppy highlights we haven't stabilized in terms of sentiment yet, and I think that that's telling, especially after what's been announced. When will we get that stability so people can come to some sort of conclusion and move on to the other factors?
Equity futures just a bit softer. Kathy Bosjanchis is going to come up, the chief economist and senior vice president. She's going to come up to the studio and join us very shortly over at Nationwide. Looking forward to that. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Thailand's Prime Minister Prayut Chan-o-cha has issued a decree to dissolve parliament. Now that decision paves the way for elections as a former coup leader seeks to extend military-backed rule despite his widespread unpopularity. By law, a national vote must be held within 60 days of the dissolution of parliament. Kazakhstan holds parliamentary elections on Sunday. President Kassym-Jomart Tokayev calls it the latest stage of a government reset in response to last year's deadly riots. Tokayev brought forward the vote in Central Asia's largest energy producer in an effort to dismantle the legacy of his long-serving predecessor. North Korea launched the most powerful ballistic missile in its arsenal just before a rare summit between Japan and South Korea, with leader Kim Jong-un saying he wanted to, quote, strike fear into the enemies. Kim was on hand with his preteen daughter to watch the Thursday launch of the intercontinental ballistic missile. North Korea has fired off about a dozen missiles in a month. The State Department approved a potential sale of a Tomahawk missile systems worth $895 million to Australia. The sale would further tighten security ties between the two nations. Tomahawks are subsonic cruise missiles that launch from ships and submarines and provide long-range, deep-strike capability. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Politics to the world of business. Balance of Power is now live from Bloomberg's Washington headquarters at a new time. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players. Balance of Power, now weekdays at 5 p.m. Eastern, only on Bloomberg, your global business authority.